I'd like to invite our witnesses to go to the witness table, please. How are you? Committee on Financial Services will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Navigating the Digital Payments Ecosystem, Examining a Federal Framework for Payment Stablecoins and Consequences of a U.S. Central Bank Digital Currency. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 4 minutes for an opening statement. Good morning and welcome to today's hearing entitled Navigating the Digital Payment Ecosystem, Examining a Federal Framework for Payment Stablecoins and the Consequences of a U.S. Central Bank Digital Currency. Global payment systems are leveraging technology and modernizing legacy infrastructure, driving innovation and expanding access while lowering costs. The evolution of payment stablecoins and their increasing adoption beyond the digital asset ecosystem reflect broader modernization efforts in the United States and the global payment infrastructure. Every day there are billions of dollars of stablecoin transactions, reducing friction in cross-border payments, streamlining commercial transactions, and giving more communities broader access to digital financial tools. Since 2022, committee Republicans have worked to establish a legislative framework that strengthens their potential to become a cornerstone of a modern payment system. Last Congress, this committee passed the Clarity for Payment Stablecoins Act of 2023. At the start of the 119th Congress, we built upon this foundation in coordination with the Senate Banking Committee. The House product, the Stable Act, which we notice as a part of today's hearing, reflects these key themes. Since its initial notice at Digital Asset Subcommittee Chair Brian Stiles' hearing last month, we've incorporated updates to the discussion draft based on the extensive written feedback that we've received. These refinements serve to strengthen the operational standards for payment stablecoin issuers, as well as clarify the supervision and enforcement authorities of state and federal regulators that will oversee these entities. The Stable Act also makes sure that Bank Secrecy Act and anti-money laundering compliance, along with cybersecurity and oversight, are a critical part of the framework. The committee is grateful for the engagement and the feedback that we've received on the Stable Act, and we hope it will continue as we further iterate and strengthen this legislation. A properly regulated stablecoin market can strengthen the U.S. dollar's dominance, modernize our payment infrastructure, and promote financial access without government overreach. It's essential that we deliberate and get this job done and done right. Unfortunately, there's a competing vision about the future of digital money, one that puts the government at the center of every transaction, and that's a central bank digital currency, or CBDC. A government-controlled digital dollar would put the Federal Reserve in direct competition with the private sector and undermine the very progress that stablecoins are making. Chair Dan Muser's Oversight and Investigation Subcommittee has explored the troubling cases of debanking of politically favored industries. Unlike stablecoins, which operate in a competitive market, A CBDC would concentrate financial power within the federal government, restrict consumer choice, and undermine innovation that has made the U.S. financial markets the strongest, most liquid in the world. A CBDC would also suppress competition, jeopardize financial privacy, and weaken the role of the U.S. banking system. I'm so grateful to my colleague and friend, Republican Whip Tom Emmer, for leading the charge to prohibit a U.S. CBDC, and I thank him for the work that he's done to get his anti-CBDC Surveillance State Act reintroduced in this Congress and noticed for this hearing. Before I close, I want to emphasize that in addition to payment stablecoins, this committee has continued its efforts on a bipartisan basis to begin the work that we began last Congress to establish a comprehensive framework for digital assets market structure. We're moving full steam ahead in this Congress to strengthen and expand that pro-innovation agenda. I look forward to today's discussion, and I yield back the balance of my time. I now recognize with pleasure the ranking member of the full committee, Mrs. Waters, for a 4-minute opening statement.
Thank you, Mr. Chairman. For years, I and my colleagues have sought to craft common sense crypto legislation with great rails for consumers and strong oversight. In less than 2 months, President Trump and Elon Musk have undermined all of this work. In fact, since taking office, Trump has only enriched himself, his crypto cabinet, and the rest of the crypto billionaire class. And he has done nothing to improve the economy, let alone anything to bring down the cost of groceries, energy, or housing, as he promised. In fact, under Trump, egg prices are up 53%. And just yesterday, the S&P 500 fell a blistering 2.7%. Trump started with the meme coin scheme that scammed investors out of $2 billion, while Trump, his family, and other insiders pocketed $350 million. And just last week, Trump signed an executive order to spend U.S. taxpayer resources to create a fund of billions of dollars of crypto that would squarely enrich Trump, Musk, and MAGA cronies already holding these cryptocurrencies. Mr. Chairman, despite my belief that the Trump administration only wants crypto legislation that personally benefits them and protects their crypto financiers, I still hope we can work together on a bill that requires stablecoins be robustly and fairly regulated. Unfortunately, the bill noticed for this hearing strips away critical protections to shield investors from criminals. The bill also tears down the wall that was used to separate banking from commerce, allowing big tech firms, including those owned by Elon Musk, to issue their own money, just like Facebook tried to do with Libra. I'm proud of how this committee stopped Libra and Facebook, and I will do everything that I can to stop Musk also. It is also clear that given Trump's and Musk's actions on crypto and the mass layoffs of the employees who would be charged with overseeing crypto, we must go back to the drawing board on stablecoins. The best starting point for moving forward is the Waters-McHenry bill, which I released a few weeks ago. Before I close, I'm so deeply concerned that we are considering a bill today to strip the Consumer Financial Protection Bureau of supervision of big tech payment apps. This comes after Trump's appointees halted all Consumer Financial Protection Bureau supervision of big banks. Moreover, the Republican resistance to even allow the Fed to study central bank digital currencies is not only anti-innovation, but it is anti-American, as it helps China win the digital currency space race and undermines the U.S. dollar as the world's reserve currency. Mr. Chairman, I am prepared to work with you and this committee, and we need to go back again to the drawing board on stablecoins and get started so we can really get into crypto. And I just believe that your leadership will take us there. I just cannot believe that this committee would follow what Trump is doing for himself and the other billionaire cronies of his. I yield back the balance of my time.
The gentlewoman yields back. The chair recognizes the gentleman from Wisconsin, the chairman of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, Mr. Stile, for 1 minute.
Thank you very much, Mr. Chairman, for holding this hearing, the golden age of digital assets. The goal of our digital assets policy is to make sure that the next wave of crypto and Web3 businesses emerge in basements and in dorm rooms, not in boardrooms and law firms. And that's what our digital assets policy will do. The digital assets and blockchain technology, they're democratizing the internet and our financial choices. These technologies can extend dollar dominance, lower costs, and expand financial choices. Just over a month ago, Chairman Hill and I released a discussion draft of the Stable Act. The bill establishes a framework for issuing and operating US dollar-backed stablecoins. We're now in the process of collecting feedback on the legislation as we move forward, and I'm excited for where we are today and for where we're going. Thank you for holding this hearing, Mr. Chairman. I yield back.
Gentleman yields back. I recognize the gentleman from Massachusetts, Mr. Lynch, the ranking member of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, for 1 minute.
Thank you, Mr. Chairman. As this committee considers a potential regulatory framework for payment stablecoins, it's critical to prioritize financial stability, national security, and consumer protection. I have grave concerns about the Republican proposed legislation that I hope we might be able to address. Naming the Republican bill the Stable Act is like calling the Titanic and telling the passengers it was unsinkable. First, allowing big tech firms like Meta and Apple to effectively become stablecoin issuers and dominate the stablecoin market leaves consumers vulnerable to financial data exploitation and removes the separation of banking from financial commerce. Next, uninsured deposits have proven to be vulnerable to systemic runs. Legitimizing stablecoins without adequate safeguards risks our financial stability. Additionally, allowing issuers a state pathway without sufficient prudential oversight creates a race to the bottom, and very little in this bill prevents money laundering and illicit finance. As every major economy races ahead of the U.S. in developing a central bank digital currency, discussions in the U.S. have been obscured by disinformation and political ideology. If my colleagues truly share the goal of maintaining dollar supremacy, they would encourage this type of innovation. Thank you, Mr. Chairman. I yield back.
Gentleman yields back. Today we welcome the testimony of Ms. Carole Butler, who's Global Head of Digital Assets at the Bank of New York Mellon, Mr. Charles Cascarilla, who is the CEO and co-founder of Paxos, Mr. Pat Collison, who's the CEO of Stripe, Mr. Randall Guynn, who's the head of Davis Polk's Financial Institutions Group, and Ms. Carole House, who's Senior Fellow at the Atlantic Council GeoEconomics Center and a Senior Visiting Scholar at Georgetown University's CyberMart Center. We're so delighted to have all of you for being here. Each of you be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written comments will be made part of the record. Ms. Butler, you're recognized for 5 minutes.
Good morning, Chairman Hill, Ranking Member Waters, and members of the committee. Thank you very much for the opportunity to testify here today on innovation in the financial system, including the use of stablecoins. My name is Caroline Butler, and I am the Global Head of Digital Assets in BNY since 2023, and prior to that, I ran our custody business. I have more than 20 years of experience working at global systemically important banks, which guide me and BNY in applying regulated banking concepts to blockchain-based solutions. In doing so, we maintain the core tenets of asset safety and protection, regardless of the technology wrapper applied to the asset. Founded by Alexander Hamilton in 1784, we are a global financial services company that helps make money work for the world by managing it, moving it, and keeping it safe. For over 240 years, we have continuously adapted to the needs of the US economy and have a number of firsts. We provided the first loan to the US government after the Revolutionary War. We were one of the first companies on the New York Stock Exchange, and we were one of the first institutions to use an electronic system for clearing government securities. These actions, often taken for granted today, were financial innovations at the time, and have played a significant role in helping the US become the world's predominant economic engine. As the world's largest custodian with more than 52 trillion of assets in custody, BNY helps companies and banks, big and small, access the money they need. BNY plays a central role in supporting US Treasury markets and process approximately 2.4 trillion of payments per day across all payment rails. Our commitment to advancing the future of finance includes the integration of blockchain. This technology has the potential to make money move smarter and faster. Stablecoins can use these benefits to serve as a complement to the existing payment services and rails we offer our clients today. BNY supports stablecoin issuers by providing our traditional banking services, payments, deposit taking, and custody. For example, we serve as the primary custodian for the reserve assets of the largest stablecoin issuer in the US today. Providing these traditional services to a new client type was a natural evolution for BNY. The stablecoin ecosystem will continue to develop as market participants explore use cases based on their business models and client needs. This ecosystem will benefit from federal legislation that advances clarity and consistency, no matter the type of stablecoin issuer or the governing regulatory regime. BNY greatly appreciates the committee's bipartisan work, past and present, in developing a federal framework towards those end goals. I appreciate the opportunity to testify here today, and I welcome any questions you may have.
Thank you very much for your testimony. Ms. Cascarilla, you are recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today. My name is Charles Cascarilla, and I'm the co-founder and CEO of Paxos. For 25 years, I've worked in financial services as an analyst, investor, and entrepreneur, getting a front row seat to the inefficiencies and systemic risks embedded in our legacy financial infrastructure. These experiences drove me to found Paxos in 2012 as a regulated financial institution using blockchain technology to re-platform the financial system. In 2015, Paxos received the first limited purpose trust charter from the New York DFS. We have worked closely with global regulators to advance the safe adoption of regulated stablecoins. Today, we provide stablecoin and tokenization infrastructure to some of the world's leading enterprises, including PayPal, MasterCard, Robinhood, and Stripe. There are 3 points I hope you will take away from my testimony. First, stablecoins are a national imperative to modernize the U.S. financial system and preserve the dollar's dominance. Second, to achieve this, the U.S. must set global standards that enable broad financial adoption and interoperability. Third, we strongly support the Stable Act, and with some enhancements, it will be truly enduring. Since testifying in 2021, blockchain technology has evolved dramatically from the periphery to the mainstream. Today, the United States stands at a critical juncture. The question is no longer whether financial markets will evolve, they already have, but whether America will lead this transformation or be left behind. The stakes could not be higher. Our economic competitiveness, national security, and the dollar's role as the world's reserve currency hang in the balance. However, one constant remains unchanged. Everyone in the world wants US dollars. When we export dollars, we export American values, free markets, the rule of law, and financial transparency. History teaches us that dominance is not eternal. For the dollar to remain the undisputed reserve currency, it must adapt to an always-on, internet-based, and AI-enabled global economy. Stablecoins represent the next evolution of money management. The global economy today demands secure, programmable payments that move instantly, 24/7 at near zero cost. This is not science fiction. It exists today thanks to blockchain. Our financial system already accommodates various forms of dollars: central bank cash in your wallet, bank liabilities in an electronic account, money market funds on exchanges, or balances held in PayPal. Each operates on different rails. A stablecoin is just a dollar that operates on a blockchain rail. This is a new and more efficient way to distribute dollars around the world to consumers. The benefits of stablecoins are profound. While bank accounts have existed for hundreds of years, nearly 20% of Americans are underbanked and 30% of the world is unbanked. Yet in 15 years, nearly 85% of the global population have smartphones. At virtually no cost, anyone with only an internet connection and smartphone can now use blockchain dollars, revolutionizing payments. I believe the private sector is the source of financial innovation, and I see no need for a US CBDC at this time. The most important innovations have been and will continue to be driven by the private sector. I want to thank Chair Hill and Representative Stile personally for developing the Stable Act. It represents a historic opportunity to cement America's leadership in finance. We strongly support the clear distinction between stablecoin issuance and traditional banking. Issuers like Paxos do not take deposits, and we do not make loans. We facilitate payments and transfers. Designating the OCC as the federal regulator for non-bank issuers is the right choice. We also endorse the bill's reserve requirements that mandate one-to-one backing, prohibit rehypothecation, enforce redemptions, and require audits. These standards mirror the high bar Paxos already meets. We appreciate that the Stable Act requires issuers to adhere to the same AML, KYC, and BSA standards as banks. No carve-outs, no exceptions. As a globally regulated issuer with firsthand experience navigating markets, I urge the committee to consider two enhancements to make the Stable Act enduring. Firstly, we recommend strengthening international reciprocity by requiring the Treasury to designate compatible jurisdictions. This approach fosters a race to the top, encouraging international partners to align with U.S. standards. Secondly, state-regulated entities like Paxos must meet standards equivalent to those imposed by the OCC. If they do, these prudentially licensed issuers should be permitted to serve customers nationwide, providing they register and report in customer states. Primary oversight should remain with their home state regulator, avoiding redundant regulatory burdens. In closing, Congress has the opportunity to act decisively. If we fail to act, other nations will fill the void, dictating the future of money on their terms, not ours. Passing clear, balanced legislation now is not just an opportunity, it is an imperative. The Stable Act, with these refinements, will secure the dollar's global reserve status and reinforce our economic leadership. Thank you for the time, and I look forward to your questions.
Thank you, sir. Mr. Collison, you're recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and distinguished members of the committee. Thank you very much for inviting me to testify about the future of our digital payments ecosystem. And if you'll forgive the sentimentality, being here is a big deal for me. I grew up in rural Ireland, just a couple of miles away from Miss Butler. I was fortunate enough to move to the US for college. This country has extended immense opportunity to me, and I want to start out by simply saying how grateful I am. This is an amazing country. My dad is actually sitting here in attendance, so I'm going to be on my best behavior. My introduction to technology was taking my first communion money and buying a computer. But in our rural Irish community, getting a decent internet connection was very difficult. And so both the promise of global connectivity, but also frustration with technology that didn't quite live up to it, were ingrained from an early age. I started Stripe with my brother in 2010 in that literal dorm room. And at the time, we were merely trying to solve what we thought was a simple problem, making it easier for businesses to accept payments online. And this was an undertaking that we'd found surprisingly difficult when starting a previous business. Today, businesses running on Stripe move over $1.4 trillion annually. We're proud to serve businesses from small family shops to Fortune 500 enterprises across the United States. We help power more than 10,000 companies in every congressional district represented here today. We build infrastructure, the out-of-sight mechanics of making payments and money movement easier. We support card payments, ACH, wire transfers, and over 100 global payment methods. And our goal is to connect businesses both to established financial rails and also to emerging payments technologies. We see this work as part of a much larger journey. Throughout history, improvements in how money moves have expanded economic opportunity, from coins to banknotes, from gold to fiat currency, and from paper to digital payments. Each transition has made commerce more efficient and more inclusive. And so it's from this vantage point that we see the promise of stablecoins. So this is why we recently acquired Bridge, the world's leading platform for developers and businesses building with stablecoins. Bridge enables businesses to move money quickly and more cheaply across borders, which in turn helps them compete more effectively in the global marketplace. And the Bridge acquisition reflects our conviction that stablecoins represent a fundamental innovation in how money moves. Now, importantly, this belief is grounded specifically in what the businesses themselves tell us. This is not speculative. They say that stablecoins deliver real utility today. We see businesses finding better ways to manage corporate treasury, to handle international transfers, and to access dollars overseas. So that is to say that stablecoins are creating economic opportunity for American businesses at this moment. Now, beyond the usability and the efficiency improvements for businesses, stablecoins also strengthen America's position in the global financial system. Despite regulatory uncertainty, approximately 99% of stablecoin balances today are US dollar based. And I often find that Americans, it's easy sitting here to underestimate how much demand exists globally for dollar-denominated assets. And this matters tremendously when approximately 1.3 billion people live in countries with average inflation rates exceeding 10%. And as such, stablecoins are enhancing the dollar's status as the world's reserve currency and lowering American borrowing costs. Stripe now supports millions of businesses of all sizes, and we're acutely conscious of the attendant responsibilities that come with that position. We believe that a trusted financial ecosystem requires clear and effective regulation. And thoughtfully constructed frameworks for stablecoins will bring certainty, stability, and safety for businesses and consumers. And that's why I appreciate this committee's consideration around an appropriate federal framework. I respectfully suggest that any legislation be based on 5 essential principles. 1, regulatory clarity. 2, flexibility and support for innovation. 3, neutrality and interoperability with existing systems. 4, robust consumer protection with a heavy focus on transparency. And 5, an outcome-based framework for ensuring system integrity and preventing illicit activity. Overall, stablecoins benefit American consumers, American businesses, the American government, and the global economy at large. Because of these benefits, stablecoins are seeing incredible adoption, with use more than doubling over the past year. I commend Congress's recognition of the fact that stablecoins are an innovation of unusual import. I'm very grateful for the opportunity to share these perspectives. I look forward to your questions.
Thank you, sir. Mr. Guynn, you're recognized for 5 minutes.
Thank you. Chairman Hill, Ranking Member Waters, and the other distinguished members of this committee. It's very difficult to follow that great opening statement. But as he explained, stablecoins are a modern digital version of private money. If a payment stablecoin issuer has a properly calibrated reserve of high-quality liquid assets, a properly calibrated capital buffer, and no material amount of other liabilities, its payment stablecoin should be as safe as insured deposits or even central bank money. While a substantial portion of the U.S. money supply consists of public money in the form of coins, paper money, and demand deposit claims against the Federal Reserve Bank, the vast majority of the U.S. money supply consists of private money. This includes demand deposit claims against commercial banks, amounts standing to the credit of a person's account with non-bank payment companies like Venmo or PayPal, and stablecoins. A central bank digital currency, or CBDC, would be a new digital form of public money that would compete with private money, including stablecoins. The Stable Act would create a regulatory framework for stablecoins modeled on the framework that applies to the dual banking system. That model has not changed fundamentally since the 1930s. It's well understood and it's worked well. As a result, it makes sense to base the regulatory framework for payment stablecoins on the framework for the dual banking system. Let me make 4 points about the Stable Act. First, the 100% reserve requirement, together with a properly calibrated capital requirement and the activities restrictions in the Stable Act, should make payment stablecoins issued by permitted payment stablecoin issuers as safe as insured deposits or central bank money. These features should reduce any run risk against a payment stablecoin issuer to a negligible or even infinitesimal amount. Second, the current list of qualified reserve assets, however important it is too restrictive. The government should allow U.S. government securities to have an original maturity of up to 1 year. The regulators can limit the interest rate risk and the overall portfolio by capping the average duration of the portfolio at 6 months or less, or some other figure. Third, there is a trade-off between the average duration of the reserve portfolio and the capital buffer. For example, if the average duration of the portfolio is 1 month, the capital buffer should be calibrated at a much lower level than if the average duration is 6 months or more. Fourth, the Federal Reserve should not be permitted to issue a CBDC unless two conditions are satisfied. First, it should be required to show that the alleged benefits of a CBDC could not be produced by private money in the form of payment stablecoins or demand deposit claims against commercial banks. And second, it should be required to show that the benefits of a CBDC clearly outweighs its considerable risks in terms of threats to financial privacy, core freedom, and financial stability. Thank you, and I'd be happy to answer any of your questions.
Thank you, sir. Ms. House, you're now recognized for 5 minutes.
Thank you, Chairman Hill, Ranking Member Waters, and distinguished members of the committee for holding this hearing and the honor of the invitation to testify on the digital payments ecosystem. I'm Carole House, a senior fellow at the Atlantic Council, having recently departed the White House for my second tour on the National Security Council. I have served at the intersection of national security and emerging technologies and finance my whole career as an Army officer, a regulator, a delegate to international standards bodies, and also a national security and strategic tech expert. I'm very glad now to see the level of support within Congress for elevating stablecoin legislation to a priority this year, and applaud the efforts to date by many here today, including Chair Hill and Ranking Member Waters, for helping to paint a clear pathway. We must ensure that our regulatory frameworks create a foundation for providing trustworthy and affordable access to financial services for consumers, while also reinforcing the centrality of the U.S. in the financial system and as the home for responsible, cutting-edge innovation in emerging tech and payments. That includes the critical need for timely progress on a comprehensive stablecoin framework that supports these objectives, as well as driving broader experimentation and competitiveness in digital payments. These frameworks must also be comprehensive of the real and present risks, as well as opportunities that we have observed in the digital asset ecosystem. For example, with proper protections, stablecoins have the potential to improve delivery and efficiency of financial products and services, to dismantle barriers to access and inclusion, and to promote U.S. leadership in payments. But let's also be realistic that most of those use cases still are in a nascent form and stage and still have time that's needed to bear out the benefits that are purported there, because most of the use cases really have been in settlement of trading activity. We also see in the wake of serious national security threats like billion-dollar hacks by rogue nations, growing integration of cryptocurrency, including stablecoins as a tool for transnational organized crime, market abuses and frauds that can threaten system stability and integrity, as well as pressure from adversarial nations that are leveraging alternative payment systems to weaken and circumvent the dollar. It is clear that strong safeguards, including for U.S. competitiveness, are needed. This framework also demands that we ensure policy and enforcement approaches, both domestically and internationally, create a level playing field for U.S. firms, often the most compliant firms in the world, to be able to compete fairly. A policy that isn't enforced does nothing to benefit consumers, nor U.S. firms with stronger compliance that have been operating at higher costs and less competitive advantages than many foreign operating firms. This framework is achievable, able to build on years of bipartisan efforts working across the aisle to construct a truly comprehensive approach. We need strong prudential consumer protections and regulations to ensure that stablecoins are truly stable. We need to be able to shift the burden from consumers doing their own research to assess which stablecoin is truly stable. In this way, a clear regulatory framework that fosters trust can actually help set conditions to drive broader adoptions and competition. We also need to have strong AML protections in place for stablecoin ecosystems. And we need to ensure that cyber and AML vulnerabilities that are being exploited by hackers, like in the recent $1.5 billion Bybit hack by North Korea, are closed in this ecosystem. I'm pleased to see many elements in the Stable Act that I support and are critical safeguards, such as high-quality reserves on at least a one-to-one basis, envision roles for state and federal regulators, and restrictions on hypothecating federal reserve assets, as well as stablecoin issuer activities. These are critical safeguards. But there are also several key elements that are missing from this proposed legislation and that have been previously negotiated. If not addressed, we risk this framework not being comprehensive and needing to be patched and fixed later in the future. So I propose some areas for consideration. Like, we must ensure federal line of sight to support supervision on issues of systemic importance. I support the state charter and the dual system in banking, and we must preserve that option, but not by denying critical visibility for agencies like the Federal Reserve to be able to fulfill their mission on overseeing financial stability and conduct monetary policy. The legislation should also broaden to include a greater scope of risk coverage like credit and counterparty risk, market risk, and concentration risks. There's also no clear articulation of an enforcement mechanism, affiliate controls, or bankruptcy resolution to protect consumers in the wake of a failure. There's also not clear enough direction on AML, sanctions, and extraterritorial application. US dollar stablecoins have been exploited by cartels and sanction evaders and terrorism financiers. We need to message that that is unacceptable and make clear that US dollar stablecoins must comply with sanctions, including freezing and recovery capabilities. So the most important message here on innovating in digital payments is that we need to do so responsibly and invest in the building blocks that will allow for us to make this system more secure and inclusive. Thank you very much. I look forward to your questions.
Thank you so much. We'll now turn to member questions, and the chair recognizes himself for 5 minutes. As I started out in my opening remarks, it's our job as members of Congress to establish a legislative framework for payment stablecoins that balances growth and innovation with strong consumer protections. And I think all of us on both sides of the aisle have that as a cornerstone. Crafting a durable regulatory framework that achieves this balance is iterative and requires extensive stakeholder feedback and engagement. Today, we'll use this hearing to further strengthen the STABLE Act, incorporating the expert testimony of our witnesses, to refine our bill's consumer protections and solidify the federal and state pathways for both banks and non-banks. Let me start and talk about banking engagement. In October 2020 and January 2021, the OCC under the Trump administration clarified that banks can both issue stablecoins and hold stablecoin reserves. But then, just a few months later, in November of 2021, the OCC, the Comptroller of the Currency Office, under the Biden administration, stated that these activities could only be conducted by banks if they received a non-objection letter. Finally, just this past Friday, the Comptroller of the Currency has issued a statement indicating that banks under its supervision will no longer need permission to engage in certain digital assets-related activities. Certainly, in my point of view, why we need a regulatory framework so that we don't do this bouncing around. But Ms. Butler, you work at BNY Mellon. You're a descendant of Alexander Hamilton. Can you explain how the STABLE Act addresses this inconsistency by changing administration and alters this rules on banks' ability to engage here?
Thank you very much, Chairman, for your question. The STABLE Act gives us the clarity and certainty to know what we can actually perform in terms of activities for our clients, and that is absolutely incredibly important. In addition, the consistency of applying those same standards across the ecosystem. So whilst we need the clarity as a bank to understand what activities we can perform, we need to know that the ecosystem we're performing those activities in is all players are meeting the same set of standards. And that's going to be very important to ensure that there is a system of trust with regulatory oversight to ensure that we can protect the safety and soundness of financial markets.
So you believe that same kind of service deserves the same kind of regulatory treatment, whether it's a bank or a non-bank, is that right?
100%. Same service, same risk, same regulation.
Okay, thank you very much. Let me turn to the topic of a state pathway, which has been a big issue over the last couple of years that we've talked about this. Throughout the 118th Congress, we took testimony on this, including from Superintendent Harris of the New York Department of Financial Services, about that balance between state and federal oversight. Any framework for payment stablecoins should build on the well-established dual banking system that many of you have talked about. Mr. Guynn, can you describe some of the benefits that the dual banking system has brought the U.S. financial system and explain how our framework attempts to replicate that for stablecoins?
Certainly. So I think the dual banking system has allowed banks to function as 50 laboratories for innovation. I think that's the most important function that they've played. The federal government has often set minimum standards for banking, but they haven't created a comprehensive federal framework that so the banks are regulated both by federal and state laws. The regulatory framework in the STABLE Act is virtually identical to the framework for the dual banking system, with two exceptions. First, the STABLE Act establishes a single federal regulatory framework in 4A that applies to all federal qualified and state qualified payment stablecoin issuers, and the alternative state level framework has to meet the standards or be stronger than the standards in 4A. So it's different in the sense that it actually creates a comprehensive federal floor.
So you would say that that prohibits, that some have argued this is a race to the bottom, and you believe that federal floor would prevent that. Is that your view?
Yeah, I don't see how there could be a race to the bottom because any state regulator who's applying the Stable Act would have to either comply with the federal standards in 4A or standards that meet or exceed those
Yeah.
standards.
And Mr. Cascarilla, I mean, you've dealt with this for years because of your work in New York. Would you say that the Stable Act is somehow light touch regulation, or do you think it strikes the balance that's important to have a high standard, but you preserve your right to work in the state of New York, for example?
Well, today we're the only prudentially regulated issuer of stablecoins, or at least New York, sorry, I should say New York State is the only place where you can prudentially issue stablecoins. And I think that's important to preserve. It creates a laboratory for innovation, as Randy was pointing out, but also having a federal floor is actually going to create a consistency across the entire country, and I think actually on a global basis. I think it would be actually a race to the top of meeting the same set of standards, which is the right way to operate. And if everyone meets those standards, you're in the right.
Thanks so much, and thank our panel. And I now call on my friend, the ranking member, for 5 minutes of questions.
Thank you very much, Mr. Chairman. Ms. House, in the 117th Congress, I reached across the aisle to work with the then ranking member, McHenry, and led years of negotiations with Treasury, the Federal Reserve, and other stakeholders to establish the first of its kind bipartisan stablecoin legislation. Unlike the Republican bill posted for this hearing, our bill creates a strong regulatory framework that supports the responsible innovation with federal oversight, along with a role for states. My bill includes appropriate supervision authority, including for third-party vendors, along with civil and criminal penalties for violations, language to address overseas threats like from Tether, and a ban on convicted individuals like Sam Bankman-Fried. In your testimony, you said, in the wake of serious national security threats like billion-dollar hacks by rogue nations, growing integration of cryptocurrency as a tool for transnational organized crime, market manipulation and fraud that can threaten system integrity and stability, as well as pressure from adversarial nations seeking to develop and leverage alternative payment systems to weaken and circumvent the dollar. It is clear that strong safeguards, including for U.S. competitors, are needed. Do you stand by that? Why is what you're telling us so important?
Yes, ma'am. It's entirely necessary. I think we all would find it totally acceptable for the nation's greatest threats to us, which often are on the other end of our sanctions, to be able to leverage the U.S. dollar and to get access to the U.S. system. Yet that is happening in U.S. dollar-denominated stablecoins. So many of the protections, like what you just mentioned on extraterritorial application, are needed in order for us to make sure that our adversaries are not exploiting our system.
Thank you very much. I think enough is going to be said here today to see the difference between what Mr. McHenry and I was trying to do and what this bill does not do. But I want to jump over to something a little beyond stablecoins. When Trump first issued his meme coin 3 days before his inauguration, I expressed my deep concern. I warned that this raised major conflicts of interest, national security risks for the country, and left consumers vulnerable to rug pulls, market manipulation, and more. Unfortunately, that has happened. Can you quickly tell everybody what a rug pull is and how it works?
Sure. With limited time, just basically when people are trying to hype up and get people to invest in an asset and making a broader promise, and then ultimately pulling out your investments in the assets, and ultimately that ends up normally crashing the market value.
Well, I expressed my deep concern, and I warned that this raised major conflicts of interest, national security risks for the country, and left consumers vulnerable to these rug pulls, market manipulation, and more. Unfortunately, that's just what happened. President Trump's insiders reportedly earned a staggering $350 million from sales and fees in the 3 weeks after his meme coin was launched. While Trump ran away with his money, reports show that a far larger number of investors lost more than $2 billion after the meme coin crashed. Meanwhile, a Republican-led SEC has conveniently stated that meme coins are not subject to their regulatory oversight. And so, with that, I just want to just say to this committee and to everybody else, whenever you see this side and that side get together to work on something, that's significant and that's important. And you cannot just erase the fact that Mr. McHenry and I put together stablecoins with the kind of guardrails that would avoid consumers from being ripped off. Now, I can't understand why anybody on either side of the aisle would ignore all of this, and a new SEC, headed by someone who does not believe in guardrails, would continue to go down this road. We're not just talking about what you have advised us about. We're talking about the way that these meme coins are put together and the rug pulls, and those insiders who know what they're doing invest all of that money up front, and then after it grows, they pull it out, and the stupid people who thought they were investing in something lose everything. Why don't everybody just understand that? Well, I yield back the balance of my time.
The ranking member yields back. The chair recognizes the gentleman from Oklahoma, Mr. Lucas, the chair of the Task Force on Monetary Policy, for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses for testifying today. I want to first focus on central bank digital currencies. As one of the few remaining members of Congress who was on the Dodd-Frank Conference Committee, I'm especially sensitive to expanding the authorities and reach of the Federal Reserve. We've seen the way partisan politics creeps into the supervision and regulation of our financial systems when we allow unaccountable agencies to look over our shoulder. As chairman of the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity, I've spent a lot of time talking about the Federal Reserve System becoming more partisan, and I expect to continue that dialogue through our work on the task force. My view is to maintain the Fed's independence on monetary policy, we must hold the Fed accountable when they overreach on the regulatory proposals. Mr. Guynn, do you think a U.S. CBDC would lead to further polarization of the Fed? And how could increased authority like the issuing of a U.S. CBDC be abused by political partisans?
Thank you. So I wish I could answer no to your question, but Operation Choke Point 1 and 2 has taught me that, unfortunately, I must say, yes, there is a possibility that would increase the politicization of the Federal Reserve. A CBDC would give the Federal Reserve staff a direct window into virtually every transaction every person in America makes, and at least one of them won't be able to resist the temptation to use that information to promote what they consider to be worthy political goals. I think the real dangers have been outlined before by Norbert Michel of Cato Institute, which is there's a real potential threat to financial privacy, to core freedom, and actually to financial stability, because if you have a CBDC in times of stress, and if it's available to retail investors, then it will, they'll have a temptation to pull money out of the banking system and move it into CBDC.
We pride ourselves here in the United States, and rightfully so, on our global leadership in technological advances. But in the case of stablecoins and digital assets, Congress's failure to put together a workable legal framework and regulatory environment is putting our financial firms and consumers at a tremendous disadvantage. Ms. Butler, why is it so important for us to catch up to the other jurisdictions on this? And what happens when we fall behind the United Kingdom and the European Union here?
Thank you very much, Congressman, for your question. As a global bank, we serve many different clients across over 100 markets, and it's imperative that we're able to use the latest and greatest technologies to meet the needs of our clients. In the US has been the world's economic leader and leader in innovation, and it's imperative to be able to take the new technologies and apply them to the needs that are in the market. It's very important to protect the US dollar. The US dollar is our largest currency for trade, And the stablecoin is just a representation of that dollar on a blockchain, but the blockchain enables the dollar to be used more because of the benefits the blockchain can yield.
Around the world, we can see CBDCs being abused by central banks, and we can't let that happen here at home. And that's why I'm a proud co-sponsor of Mr. Emmer's CBDC Anti-Surveillance State Act. Mr. Cascarilla, Mr. Emmer's bill would prevent the federal government from surveying and restricting American spending habits through a CBDC. In your view, what is the risk of failing to pass a bill with these protections?
I think the key point with the CBDC is that it's creating a competitor to the private sector. And right now we're at a stage in the market where you need to have as much innovation as possible. And we need to have stablecoins become as broadly adopted as possible for the benefit of the United States and for the U.S. people.
In my remaining time, Mr. Collison, could you discuss the potential impacts of stablecoins on financial innovation and why it's important for consumers in my district to have access to these technologies?
Stablecoins make money movement faster, cheaper, and more programmable, creating entirely new kinds of financial applications. And we've been very struck from our Stripe vantage point about how this adoption is already occurring. I think it's important to emphasize it's not speculative. We see it today.
My time's expired. Yield back, Mr. Chairman.
Thank you, sir. The chair recognizes Ms. Vasquez, the ranking member of the Small Business Committee, for 5 minutes.
Thank you, Mr. Chairman. And let me start off by thanking you for holding this very important hearing. We need to have a serious discussion about the future of stablecoins and the use of digital assets in our country. And I think to do that, we need to discuss the broader context and environment in which we're holding this hearing. Since being sworn in as president, President Trump has sought to hand control of our financial system to the richest man in the world, a man who spent millions of dollars to get Republicans elected. Elon Musk and Doge have sought to destroy the CFPB, gain access to the Treasury Department's payment system, and frozen rulemakings, litigation, and enforcement actions, not to mention firing or laying off thousands of federal employees, many of whom perform critical oversight roles in the regulators we are discussing here today. Now, Elon Musk is working to transform X.com into a virtual wallet and payment system, and according to Medium reports, ambitions to create his own stablecoin. So, Ms. House, as we sit here today discussing the merits of stablecoin legislation and what is likely to be a broader discussion on digital asset legislation later this Congress, do you think it is important for us to keep this broader context in mind?
Yes, absolutely, Congresswoman. When we have the privilege and honor of serving in office and for the government, we have a sacred duty to maintain the public trust and to ensure that our activities are there. It's why there's so many clear protections, like things of conflicts of interest. So it makes sense to keep that context certainly in mind.
Thank you. And Ms. House, CDBCs are official government-issued stablecoins that operate with all the protections and rules of their traditional counterpart. Private stablecoin issuers don't like them because they are a threat to their issuances. They hide this fact by arguing behind things like government control and infringement on individuals' right to privacy. Ironically, one of the bills we're discussing here this morning bans CDBC experimentation in the name of privacy. Yet, as you correctly pointed out, the bill does nothing to address privacy issues presented by private crypto companies. Can you explain your statement? What privacy concerns do you think need to be further addressed in this proposal?
Thank you, Congresswoman, for the question, and I appreciate this point since I wanted to underscore that the U.S. Treasury, the Federal Reserve, the prior White House, and then it looks like this Congress have all agreed, in fact, that the Federal Reserve does not have the authority to issue a CBDC. So the the legal necessity of the legislation on banning issuance of a retail CBDC remains in question to me, but thank you for highlighting the broader issues on privacy. There's no reference to broader issues of privacy, just generally privacy legislation that's still needed, as well as what the privacy implications are, certainly for publishing transactions on a public unobscured ledger that present risks to consumers.
Thank you. Ms. Butler, in your testimony, you highlight that BNY performs custody services for stablecoin issuers in accordance with regulations, guidance at both the state and federal level. How does the current participation of banks in stablecoin arrangements facilitate broader trust and reduce risk in the financial system, particularly compared to non-bank participants?
Thank you very much for that question, Congresswoman. So we do indeed custody the reserve assets, and we do so in accordance to our long-standing custody practice. We've been providing custody for decades, $52 trillion worth of custody, and we apply the same customer and asset protections to the reserve custodian work that we do to the traditional side. So it's effectively the same custody we provide, and we take all of the protections and apply it as well. What's very important for the ecosystem is to make sure that with banks that are providing custody, there is implicit trust and confidence in the ecosystem that clients' assets are indeed protected, and protected according to federal legislation and regulation.
Thank you. And I yield back, Mr. Chairman.
Gentleman yields back. The gentleman from Michigan, the Vice Chairman of the House Financial Services Committee, Mr. Heisinger, recognized for 5 minutes.
Thank you, Chairman Hill, and good to see many of you again. And I do want to note, Mr. Collison, I know your dad is back there, and I'm sure he's very proud. I had a chance actually to be at your headquarters out in San Francisco a number of years ago, pre-COVID. Met with your brother John in his opulent office. For those that haven't been there, he's laughing because he knows what I mean. If you haven't been there, it's a cafeteria. That's their opulent office space. But it was great. My tribe happens to hail from Cork, a little further down, I think, the coast from the two of you, and with a Dutch name, it throws everybody off. But it is the season to see some good Irishmen around. So, Mr. Chairman, as you know, and as everybody knows, stable coins hold immense potential. I think you've seen a little bit of that getting talked down on the other side by some. But as you all have demonstrated, the capacity to simplify our payment system is going to be huge. I've been bouncing back and forth. I also sit on the Foreign Affairs Committee, where I am doing a review of BIS and where chips are and where AI is going. It terrifies me and fascinates me every time I get a briefing. But this is where the rubber is hitting the road, and I just applaud you all. Obviously, we've seen President Trump's actions, Secretary Bessent, the crypto czar, Mr. Sachs, and others. I think there is a moment for us here in Congress now to act. And as legislators, it's ultimately up to us to provide the regulatory clarity needed to ensure that the U.S. dollar remains the dominant reserve currency, and I believe stablecoins can do that. But I want to start by just setting the stage, and this question is for all of the witnesses very briefly. And Ms. Butler, let's start with you. Please highlight one aspect of the proposals that you have seen that you think hits the mark.
Thank you very much for your question. I would say asset segregation. This is the foundational principle of custody, and it needs to be preserved at all times, never commingling client assets with firm assets. We need to make sure that that is preserved in the digital ecosystem as well as the traditional ecosystem.
Mr. Cascarilla?
I agree. I think the most important thing is to make sure that a dollar is always a dollar. And the way you can do that is by having legal protections for how the assets are held, which is why holding assets in a trust and a custodian are important. And then secondly is making sure the assets can't fluctuate in price, which is about having a very clear set of guidelines of what is investable. And that allows a dollar to be a dollar, and really, therefore, gives everyone confidence to use this in everyday commerce all over the world.
Okay. Mr. Collison?
My answer would have been the same as these two witnesses, but for the sake of variety,
Good,
I'll say
okay, I'm good with a good theme, that's all right, but yeah, give us a little spice.
having a viable state-based framework as the laboratory, for innovation, I think is very helpful.
You said state-based
Yes,
as well.
yeah, in addition.
Yep, Mr. Guynn?
So I think the goal to become truly accepted as money, stablecoins need to become no questions asked money. That's sort of the standard that economists have developed recently. And I think there are three aspects of the Stable Act that actually should help stablecoins achieve that. The 100% reserve requirement, the properly calibrated capital requirement, and the restriction on activities that would prevent it from having any material amount of other liabilities other than stablecoin liabilities.
Ms. Howes, what do you think is hitting the mark?
Great. I totally agree that on the measures that are in there, the ones like the one-to-one reserve requirement and the restriction on rehypothecation of assets is absolutely fundamental. As a cyber nerd, I'll say the reference to cybersecurity protections also very much appreciated.
Okay. In the discussion draft of the Stable Act, stablecoin issuers are permitted to issue stablecoins through a subsidiary. Mr. Guynn, what are the pros and cons, real quickly, on requiring issuance of that subsidiary?
Yeah, so they're mostly pros, but I think the most important thing is it's very easy to match up the reserve with the stablecoin liabilities. If you actually were to issue stablecoins out of an entity that's engaged in a whole variety of activities, it'd be very difficult, particularly if the issuer were an insured depository institution, because there are depositor preference rules that give depositors preference over, say, a stablecoin holder, and there are also restrictions on securing liabilities of an insured depository institution.
Okay, my last few seconds, I'd love to have more time, but yes or no from each one of you. MiCA is now the law of the land in EU countries. Should we be following their lead? Ms. Butler?
We should be following the lead in the sense of giving clear guidelines as to what
their
can and
structure?
cannot be done. We should engage the private space like we're doing and ensure that we take the best of the rules that are in MiCA and apply them here.
Okay, well, I've run out of time. That was a very good political answer, but I will follow up in writing with everyone. So thank you very much.
We invite everybody to answer the question in writing. And now we'll turn to the gentleman from California, Mr. Sherman, the ranking member of the Capital Markets Subcommittee, for 5 minutes.
Article 1, Section 10, Clause 1 of the United States Constitution, Congress shall have the power to coin money and regulate the value thereof. So the Constitution says coining money is supposed to be done by the federal government. Now the private sector gets in and comes before Congress and says, isn't it outrageous that the federal government is competing with us? And we've got to hamstring them and make sure they can't compete with us effectively. This would be like saying that, now you can say that the federal government is supposed to coin money so it can't be electronic. That would be like saying that the federal government can only build roads designed for horses and buggies and that we should have private toll roads for automobiles. Mr. Guynn, I think you made the point very well. You said it's unfair to have a CDBG because it's too reliable, it's too secure, and in times of stress, that's where people will put their money. Then we're told, oh, but we're going to have privacy. Yes, Sam Bankman-Fried and Elon Musk is going to know every damn trade, every transaction I engage in. Then they're going to sell that information to anybody who wants it, and then we're going to pass some loophole-ridden law to say they can't do it, and they'll just do it overseas. So the idea that you're going to have privacy by giving the crypto bros all the information and letting them sell it to anybody they want, there's only one advantage of the coins we're talking about, stable coins, and that is the crypto bros can make money from it. And the goal of this hearing is to make sure that we don't have any competition from Section 10 of Article 1. This is about the 400th hearing we've had on promoting cryptocurrency. We haven't had a single witness come and tell us and make the case that we just simply shouldn't have the cryptocurrency. We're told if you invest in America and build jobs by investing in common stocks, your broker will send a Form 1099-A and you'll have to pay taxes on your gains. And then this Congress says, invest in crypto, create no jobs except the jobs moving money around in crypto, not a single manufacturing job, and you pay no taxes. Ms. House, Zelle is an electronic system. Unfortunately for some people, it's not really good for tax evaders or people trying to hide their money from their former spouse. It's free. Our other witness has a system that's similar. They charge 2.9% at Stripe. Why would, other than concealing assets from the government and former spouses, why would somebody go with a 2.9% fee rather than a Zelle, which is free?
So, and not knowing some of the specifics of Zelle, since I'm not a user, I think that there's interest in some of the broader marketplace applications where stablecoin is. Honestly, since most stablecoin activity is happening in trading, that's really where Zelle isn't settling trading activity on crypto exchanges.
I've got to make just one other point. Mr. Cascarilla tells us that people have iPhones and they're unbanked, and we're going to get them banked. So the best way to get them banked is to have a CDBG. You want to prohibit that. Then it's talking as if CDBG would be mandatory. Why not just have one more competitor? Some people will want Elon Musk to know about their transactions and will trust him, and some will want to trust the federal government. But we want to deny them the choice, because anything that prevents Elon from making a profit, anything that prevents the crypto world from making a profit must be snuffed out, no matter how useful it is to consumers. Okay. What could go wrong? I think Sam Bankman-Fried illustrated that to us. Ms. House, you have laid out in your testimony the protections we could have for Know Your Customer and anti-money laundering. And I guarantee that the industry will block all of those that are effective, because this industry can't compete against the dollar unless it has an advantage. And that advantage is not that it's electronic, because even Zelle's electronic. They're trying to snuff out a CDBG, which would be electronic. They can only compete for the tax evasion and spouse avoidance.
The gentleman's time has
I yield
expired.
back.
Gentleman from Kentucky, Mr. Barr, the chairman of the Financial Institutions Subcommittee, is recognized for 5 minutes.
Mr. Guynn, let's just start with Mr. Sherman's concern that the Stable Act might be inconsistent with Congress's power to coin money. Can you set the record straight about why the Stable Act is consistent with Article 1, Section 8, and Section 10 of the Constitution?
Well, for over 250 years or so, close to 250 years, states have chartered banks to issue private money in the form, first of paper money, and secondly, as demand deposit claims. So in fact, as I mentioned earlier in my testimony, that private money accounts for anywhere between 80 and 90% of the U.S. money supply. The coins, the paper money, the claims against the Fed actually only account for a small fraction of it.
Yeah, thank you for setting the record straight there. And I totally agree with Mr. Cascarilla's point that stable coins are a national security imperative for the United States, not only to modernize our financial system, but ensure the maintenance of the dollar's dominance, not just against Bitcoins or digital currencies, cryptocurrencies, but also CBDCs that are competitors potentially to the dollar, the digital yuan, for example. I do care about banks, and I care about the growth, the economic growth that are sourced from our banks. And I think of community banks in Kentucky and the deposit base that's used to then extend loans. Some of the bankers, the community bankers out there express concern about CBDCs and maybe even payment stablecoins in terms of the risk to eroding the deposit base. Ms. Butler, how might stablecoins issued under the Stable Act be different than a central bank digital currency in terms of eroding or the potential to erode the deposit base?
Thank you very much, Congressman, for that question. I think there's a couple of reasons. First, there's consistency of applying the same set of standards across the ecosystem. So whether you are banks or non-banks or the size of a bank, you can actually participate in the ecosystem with clarity of what you can and cannot do. That's super important. Secondly, the asset protection rules that are proposed in the legislation are very important to protect that safety and soundness of the ecosystem, including the customer protections, AML, BSA, and making sure, and we're committed to making sure that those are always protected at all times, carrying over what we do in the traditional financial system into the digital financial ecosystem. And then finally, in allowing innovation to grow with a competitiveness at the backbone, right? That's how markets thrive, when you have competitive solutions coming to the market.
And so what role do you see, Ms. Butler, what role do you see banks actually playing in the payment stablecoin ecosystem under the Stable Act?
Thank you very much. We see ourselves performing a very similar role to what we do today, providing trust and confidence in the ecosystem and enabling our client needs to be met by a variety of different payment rails. Today, we offer a variety of payment rails. This is a new mechanism for payment, and we'll continue to evolve payment rails as technologies evolve.
Mr. Guynn, another question for you. Last Friday, the OCC rescinded OCC Interpretive Letter 1179, which required OCC chartered banks to receive supervisory non-objection before engaging in digital asset-related activities, including payment stablecoins. In addition, the OCC withdrew from 2 interagency statements as they apply to national banks and federal savings associations, the joint statement on crypto asset risks to banking organizations and the joint statement on liquidity risks to banking organizations resulting from crypto asset market vulnerabilities. Mr. Guynn, what do these actions mean for the banking system?
This means that the banks can now, without uncertainty, act as custodians, act as service providers, act as issuers of stablecoins, which I think is a good thing. It never, in my view, it never should have been put on hold. And it's a good thing, and it's a good experimentation. The OCC is a perfectly competent regulator to manage and supervise the risks of those activities.
What other actions could both regulators or Congress take to ensure that banks have the clarity necessary to engage with the digital asset ecosystem while maintaining compliance with other bank-related laws?
So I think they could do something very simple. They could issue a regulation that says that acting as an agent or principal with respect to digital assets, including stablecoins, is financial in nature for purposes of the Bank Holding Company Act.
Well, as you see from my questions, I think that the Stable Act is a very important step in the right direction, and I think banks can participate in the stablecoin ecosystem in a way that fosters innovation and includes banks in this process. So with that, I yield.
Gentleman yields. The gentleman from New York, Mr. Meeks, the ranking member on the House Foreign Affairs Committee, is recognized for 5 minutes.
Thank you, Mr. Chairman. Let me start out with Ms. Butler. You know, there's been a lot of concern about debanking crypto companies with mixed messaging from the federal regulators on how traditional finance can integrate with and provide essential services to the crypto industry. Bank of New York is a New York State chartered bank that has been actively working with crypto companies. And this has been facilitated by clear guidance to banks from the New York's Department of Financial Services and has led to a vibrant crypto ecosystem in New York for crypto companies and traditional financial institutions. New York's leadership here demonstrates the importance of a strong state pathway for stablecoin regulation. Can you talk about the importance of working with the New York's DFS in building a strong, well-regulated crypto ecosystem in New York?
Thank you very much, Congressman, for your question. We work very closely with the New York DFS and with all our regulators. And given the evolving nature of this space, it's very important to have that very engaged dialogue on a continuous basis to ensure that, again, we know the clarity that we can operate in, and as these rules evolve and as the ecosystem evolve, we can make sure that there's a two-way communication. But clear and consistent framework across the entire ecosystem needs to be upheld at all times, and it needs to not be whether you choose a state pathway or whether you choose a federal pathway. We need to have consistency at the federal level for our regulations and our legislation so that we can ensure the integrity of the entire ecosystem and all players are meeting that high standard.
Thank you for that. And let me go to Mr. Cascarilla. You spoke about Paxos' history with the New York State DFS in your testimony. What do you see as the advantages of state regulation as a stablecoin issuer?
Thank you, Congressman, for the question. The New York DFS was the first regulator in the world to approve the issuance of a regulated stablecoin. And I think that underscores the importance of having a state pathway that allows innovation to happen and continue to happen. In fact, the regulations and the framework that the DFS has constructed has been, I think, the cornerstone for a number of regulators around the world as they have built their frameworks. I think that really shows how important it is for the states to be able to lead. If we didn't have New York leading, today there wouldn't be a prudentially regulated stablecoin issued from the United States.
Now, I, like many of my colleagues, have concerns about the use of stablecoins and other digital assets by illicit actors. And I appreciate that you and I have had the opportunity to discuss the importance of including strong illicit financing protections in any stablecoin bill that becomes law. What is your perspective on where the greatest risks are, and how should we think about addressing them?
I think it's very important to make sure that there are bank standards, which today Paxos adheres to, for AML, KYC, and BSA. The last thing we want is anybody using these products illegally. I think also this new technology creates new tools. So there has to be new frameworks, there has to be new ways to be able to understand how assets are being utilized. And in the one hand, will create new ways for people to have access to this, which is important. On the other hand, it could create new ways for people to use it illegally. And with the right types of protections and the right types of bank-like standards for knowing your customer, I think you can have a framework that allows you to marry both the risks and the rewards in the right way.
Thank you. Let me also, in the time I have left, to go to Mr. Collison. We talk a lot about stablecoins here in a theoretical sense, but the practical, real-world applications for everyday people are often overlooked, in my opinion. From your perspective, how can stablecoins broaden access to essential financial services for communities, both domestically and internationally, particularly in underserved regions and in countries experiencing severe currency volatility?
Yeah, so I think there are extensive applications here in the US where many forms of payment are slow and expensive. Dan Ari, a professor at Columbia, described the US's payment system as the most expensive in the G20. But even more importantly, internationally, precisely as you point out, a very large fraction of the world's population lives in a country with a significantly unstable or inflationary currency, and providing those people with access to, one, a stable reserve currency, that is to say, the dollar, but then secondly, the ability to engage on a level playing field with the world's, in the world financial system is a huge deal for them.
Thank you. Time has expired.
Gentleman yields back. Chairman of the Small Business Committee, Mr. Williams of Texas, is recognized for 5 minutes.
Thank you, Mr. Chairman. And Chinese involvement in digital assets and the blockchain could raise serious national security concerns for the United States. And blockchain technology has been the potential to revolutionize various industries like finance, supply chains, and infrastructure. And if China gains a competitive advantage over the U.S., it could have leverage over economic and national security interests through surveillance and cyber attacks. It is key to maintain U.S. dominance and keep bad actors from jeopardizing our national security. So, Mr. Cascarilla, would you describe the consequences of stablecoins being primarily denominated in the Chinese yuan and not the U.S. dollar?
I think fortunately right now, 98% of transactions that are happening in the crypto-related space are happening against U.S. dollars. Of course, that doesn't always need to be the case in the future. And if the U.S. has not set a clear framework, that does open up the possibility for other nations and other types of currencies to gain not just a foothold, but even a predominance, which of course would be problematic for the United States.
All right. Stablecoins are becoming extremely popular in the payments network, and are operating on the decentralized network gives users a degree of financial freedom, whereas a central bank digital currency gives the government more control over private citizens' transactions and can lead to increased consequences with privacy, supervision, and overall financial freedom. We must allow for more innovation in the digital payments world, not constructing growth with a central bank for digital currency. So, Mr. Collison, does Stripe have any examples of customers using Stripe's stablecoin orchestration platform to break free from authoritarian governments or deflationary national currencies?
Thanks for the question. We see many examples of this. I think of the comparison to the petrodollar system, where starting back in the 70s, the series of agreements with Gulf states created an enormous new source of secular demand for dollars. We're seeing the same thing happening today in emerging markets, where people are taking enthusiastic advantage of this new liberty and this new capability where they can hold dollars and they can, again, get direct access to the world's preeminent reserve currency. I think this is a really big deal for global liberty and for global prosperity.
Quickly, this committee feels strongly that the interact of a federal regime for stablecoin issuers will ultimately inhibit China's ability to control this space. We've seen countries around the world take action to establish national regimes for stablecoins. EU, Japan, UK, Singapore have all taken steps to establish the regulatory framework for stablecoins, recognize potential to modernize payments and enhance financial. So, Mr. Collison, again, quickly, as a global payments company, could you elaborate on how important it is for the U.S. to establish a federal framework to maintain U.S. competitiveness?
I think this is important for two reasons. One, there are the practical benefits for American consumers and for American business today. And I think it's simply on those merits worth putting forth a formalized federal framework that enables the stablecoin ecosystem here in the country. But then I think there's a second reason. I think this is what you're getting at, that while it is the case that an overwhelming majority of transactions today are in fact denominated in dollars, and that's enormously to the US's benefit, there is a risk that if the US adopts a posture of discouraging and inhibiting stablecoin adoption, that the rest of the market will respond and adapt. And perhaps we're here in 5 years and the preeminent stablecoin currency is euros or renminbi or some other global currency, and I think that would be to the US's detriment.
Mr. Chairman, I yield my time back.
Gentleman yields back. Chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Mr. Chairman. First of all, let me say, I totally agree with Ms. Waters. She gave a brilliant opening statement, and I hope everybody heard that. It was plain, it was clear. First of all, I did a little research. Stable coins are often promoted as safe, but they're not. For example, the stablecoin beanstalk suffered a heist in which attackers manipulated governance mechanisms and they stole $182 million in crypto assets. Another bridge hack resulted in the theft of $320 million. You think that's safety? And here's another one. In 2023, Curve Finance, which is a major platform with exposure to multiple stablecoins, fell victim to a vulnerability that led to tens of millions of dollars in losses due to an exploit in its smart contracts. Do you all know this? Now, Ms. House, am I scoring some points here? How in the world can we say they're safe when we're losing all of the millions of dollars? So my first question is, given these vulnerabilities, what regulatory frameworks can be applied to protect consumers and financial stability in the face of ongoing stablecoin heists, losing millions of dollars in our economy?
Yes, Congressman, thank you for the question. And this was a critical issue and priority, certainly at the National Security Council also, seeing hundreds of millions and billions being stolen by illicit actors and in some cases nation states who were fueling their proliferation activities with these heists. One of the most critical things that's being exploited specifically in these heists is poor cybersecurity. Many of these heists are being exploited because of poor key management and basically just basic information security practices not being put in place in some cases, and there's not been enough of a focus and organization around standards and security. So the prudential protections, largely the ones that I outlined earlier and which are present in the McHenry-Waters bill in a more fulsome way, I think will help to reinforce some of the security measures and protections that need to get put in place to defend against these exploits.
Let me ask you this. Should the United States consider requiring stablecoin issuers to hold fully audited reserves at insured banks to prevent cascading risks in the event of a breach?
Roger, yes, Congressman. I do believe that the full reserve holdings is critical, and I'm glad to see that being reflected across several pieces of proposed legislation.
And how can federal agencies ensure that stablecoin issuers adopt industry's best practices in cybersecurity and risk mitigation?
Great. The first would be ensuring that federal agencies have a line of sight for oversight on especially systemically important and very large stablecoin actors that will serve as very high-value targets and have the responsibility to custody many of these assets. So making sure that at least on some of those critical components that there is the federal arm of oversight. Beyond that, I do think that work like standards, that there is an absence to a certain extent of standards. Decentralized communities have a tougher time organizing, so I think that some prompting and encouragement from the government side to help to identify where certain vulnerabilities are being exploited, and also to create new standards that are bespoke and unique to the blockchain space.
Well, let us hope you're right, and thank you for your excellent testimony. Thank you very much.
Gentleman yields back. Chair recognizes the distinguished Republican whip of the House, Mr. Emmer of Minnesota, who is also the author of the Anti-CBDC Surveillance Act. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Thanks for those words and for holding this important hearing today to study the promises of stablecoin technology to unlock economic efficiencies and the risks of central bank digital currencies to our privacy and freedom. I appreciate the committee's efforts to incorporate my feedback into the stablecoin bill over the past several Congresses, and I'm grateful to this committee for noticing my bill, the Anti-CBDC Surveillance State Act, in this hearing today. The bill's simple. It halts the efforts of unelected bureaucrats from ever issuing a central bank digital currency that could upend the American way of life. This bill has the support of over 100 members of Congress and groups ranging from the Independent Community Bankers Association and the American Bankers Association to Club for Growth, Heritage Action, and the Blockchain Association. CBDC technology is inherently un-American, and I'm grateful to President Trump for understanding this and signing an executive order banning CBDCs as one of his first actions as president. My bill would codify the executive order into law and prevent a future administration from creating such an obvious tool for financial surveillance against its own citizens. Chad, great to see you, Mr. Cascarilla. Proponents of the United States central bank digital currency often cite global competition in the race to extend the dollar's status as the world's reserve currency as promises of a CBDC. Do you think there's anything a potential United States CBDC could accomplish that a privately issued stable coin could not?
Thank you for the question, Congressman Emmer. I don't think so. I think historically innovation in the United States in both technology and in the financial services landscape has come from the private sector, and I think that is what we should continue to embrace, and I think that's what the bill would enable.
Well, speaking of stablecoins, Section 15 of the Stable Act requires, the proposed legislation requires federal regulators to create and implement reciprocal agreements between the United States and jurisdictions with substantially similar regulatory frameworks for dollar-backed payment stablecoins. Can you explain the impact this section will have in extending the status of the dollar as the world's reserve currency?
Thank you. Yes, I think the important point is that everybody wants a dollar. The U.S. is, of course, the home of the dollar. When we're exporting dollars, we're exporting American values. We want to make sure we have the same set of rules in the U.S. as we have around the world, so that there isn't some arbitrage that's possible to issue from another jurisdiction. And by having that same set of rules that everyone has to meet in order to access the U.S. market, it will actually create a race to the top, not a race to the bottom.
Thank you, Mr. Cascarilla. CBDCs introduce significant privacy risks and are fundamentally the antithesis of American values. On the other hand, this stablecoin bill can bring traditional finance on-chain at a global scale while preserving privacy, individual sovereignty, and free market competitiveness. This underscores why we must prioritize pro-stablecoin legislation alongside anti-CBDC legislation. I want to thank Chairman Hill again, and especially for working with me on the anti-CBDC Surveillance State Act, both in this Congress now and in the last Congress. And I'd like to applaud the efforts of Representative Warren Davidson, Representative Andy Ogles, and former representative and a good friend of the chair and myself, Representative Alex Mooney, for their contributions to this text and for helping make it a stronger legislative proposal. I yield back the rest of my time.
Thank the gentleman. Gentleman yields back. Gentleman from Massachusetts, Mr. Lynch, the ranking member of the Digital Assets, Financial Technology, and Artificial Intelligence Subcommittee, is recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. House, currently, just a couple of stable coins have about 90% of the market. Is that correct?
Yes, sir.
Yeah.
Yes, Congressman.
So this market is susceptible to concentration.
It does, yes,
Yeah.
Congressman.
So we're looking at Meta. Meta's got 3.9 billion subscribers across all its platforms, Instagram and WhatsApp, as well as Facebook. And Apple probably has 1 billion paid monthly subscribers. What would be the impact if both those firms came in and just established stable coins? What would happen to the competitiveness of the market here in stable coins?
It's an interesting exercise. I think first off, it depends on if there's a regulatory framework that would help to enable competition and enable protection for some smaller players to come in. But without protections against it, I think that the potential for them to come in and leverage very, very large market shares with their devices and applications and others, it's possible that they could take over. Of course, without protections, there's still very major players, especially foreign operating ones that have currently been operating without much transparency or consumer protection also that they'll be coming up against.
And if they are able to operate in a fashion, well, stablecoins operate a lot like deposits, so that would break down the separation between banking and commerce, would it not?
Yes, absolutely. That's also a major risk. If you start to conflate those and you don't have the kinds of protections that we do in the banking system for good reason to divorce and separate banking and commerce, then that would present those major challenges as well.
Mr. Guynn, is that I don't want to pronounce your name wrong.
Sorry, it's Guynn.
Guynn, I'm sorry. First of all, thank you for your testimony to all the panelists. You mentioned a couple of times that stablecoins should be as safe and as secure as FDIC-insured deposits. But in the past several years, I sit up here and I see the collapses. So we've had at least 20 stablecoins just collapse. We've had every single major stablecoin in the world depeg from the dollar. So we've watched as the Federal Reserve and FDIC had to go in and rescue Silicon Valley Bank. I mean, did that not happen?
It certainly did, and I think
okay.
the reason...
I just, because this is the first time any of you have said that happened. Look, the idea of scientific method is when you try something and it doesn't work and it blows up and it causes people damage, you adjust and you develop improvements. But we keep doing the same thing over and over with stable coins. They keep blowing up. And now we want to, my time, now we want to just expand that. We just don't, and it just seems like it's inviting a disaster. I guarantee you, I read the Genius Act, over in the Senate. I'm a little wary about anything called genius coming out of the United States Senate. But there were so many problems with that, and I'm hopeful that my colleagues, on Mr. Hill and others, will amend that vigorously, because it had huge problems. But the other piece of this is stable coins, especially if they offer interest. Do you support stable coins that offer interest, that are actual deposits?
Are you asking me that question?
Yeah.
I think if they
Yes
had
or no? It's pretty clear.
No, I think it's
interest-bearing
yes.
stable
I
coins.
think it's yes if they have appropriate calibrated capital.
That's what I was fearful of. So instead of traditional bank, here's the difference. Stable coins, it's going to take deposits, and it's going to use those deposits as reserves, right? That's how this thing is going to work. A normal bank, and it's going to have to hold those for protection. A normal bank, traditional bank, would take those deposits and lend them out to small businesses, mortgages, and that type of activity. I'm afraid it's going to siphon off a lot of the credit market, and we'll be using those deposits to back the stable coins to prevent disaster, instead of putting that money to work. Ms. House, is that a legitimate concern?
I think the concerns are founded, and why bipartisan legislation on a good regulatory framework is critical.
Thank you. I yield back. Thank you.
Gentleman yields back. The gentleman from Georgia, Mr. Loudermilk, is recognized.
Thank you, Mr. Chairman. Thank you all for being here. This is a very timely discussion we're having. In fact, while you guys were giving your statement, I was meeting with some middle school students talking about financial markets, which obviously these students, as I was zooming into them, their eyes were glazed over. Until I got to the point about digital assets, that's when they perked up and listened. Why? Because this is their age. This is the technological revolution they're growing up with. And either we fall way behind in technology, as we have in previous decades, or we try to keep up with it, and we make the inevitable part of a viable free market system and our economy. I'd like to kind of follow up on the previous questions, Mr. Guynn. Both stablecoin depegging events and the 2008 Reserve Primary Fund crisis involve the loss of confidence in an asset that is supposed to maintain a stable value. When the primary reserve fund broke the buck, it led to investor panic and liquidity crisis in money markets. Similarly, when stablecoin depegs, such as what we saw in Terra USD, investors rushed to redeem, potentially destabilizing the markets. Mr. Guynn, can you compare and contrast the risks posed by these two events in terms of systemic impact and redemption dynamics?
Yes, definitely. So the Reserve Primary Fund is a money market fund. They're not required to have capital requirements, and so when their assets fell below parity, they were basically, they had less than what they needed to redeem all the interest. Terra USD is an algorithmic stablecoin issuer, and so it did not have a 100% reserve with safe assets like would be required here. So that would not have been a payment stablecoin. Here, in contrast, the entities would have 100% reserve requirements, they'd have a properly calibrated capital requirement, and they'd have restrictions on their non-stablecoin activities. Those three things make them fundamentally different from the Reserve Primary Fund, Terra USD, and the stablecoins that he was talking about earlier.
Okay, thank you. That's why I want to give you some time to actually respond to the question. Follow-up, while the types of assets that can be used to back stablecoins in the Stable Act are recognized as highly liquid cash equivalents, it seems like there could be slight variations in the liquidity of these assets at times. At a high level, how would different asset mixes affect redemption mechanics during a mass redemption event, and how can we avoid liquidity mismatches?
Yeah, so I think the permitted assets now are very short-term. In fact, as I said in my opening statement, I think they're overly restrictive, but I do think that they need to be have a duration of something like 6 months or something like that on an average basis, they need to be short-term so they can be liquidated, so that even if interest rates went up and their value went down, they could be liquidated pretty much at par, close to par. And then to the extent they're not exactly at par, instead of having the situation with the reserve, the reserve primary fund, they would have a capital buffer that would allow them to make up the difference.
Okay. Last question. The Stable Act requires stablecoin issuers to periodically publish information on the reserves backing a stablecoin. Can you explain how this might mitigate risk related to mass redemption events?
Yeah, that public disclosure is critically important to that, and also to distinguish a payment stablecoin issued under this act and other stablecoins. As I said earlier, the goal is to structure payment stablecoins so that they are what economists call no questions asked money, so you can have absolute confidence in them. And so I think that that's what needs to be done, and I think that the Stable Act should accomplish that.
Okay, thank you. Ms. Butler, for the few moments I have remaining, on Friday, Treasury Secretary Scott Bessent said that stablecoins would help ensure that the U.S. dollar remains the world's reserve currency. How would the demand for treasuries created by the new stablecoin collateralization requirements affect the demand for U.S. dollars and U.S. dollar foreign exchange rates globally?
Thank you very much for the question. Given that U.S. treasuries are actually one of the non-cash assets held in the reserve, it would stand to reason that as the demand for U.S. dollar represented on chain, i.e. a stable coin, grows, that you would see that underlying reserve grow as well. And that backbone of the global economy today, in terms of trust and security being the U.S. Treasury, would continue to be there in the form of a U.S. stablecoin.
Okay, thank you. I yield back.
The gentleman yields back. The gentleman from Missouri, Mr. Cleaver, the ranking member of the Housing and Insurance Subcommittee, is recognized for 5 minutes.
Thank you, Mr. Chairman. Is there anyone here who does not believe that in 2008, the central focus of the economic collapse in our country had nothing to do with housing? Is there anyone who believes that housing was the central fact?
I think it was housing combined with very leveraged investments in real estate.
Okay. Everybody else agree? Thank you. From the ranking member, Maxine Waters, and all the way down to me, we were here on the day that the Secretary of Treasury came in and told us that we were in a position where we had to act very quickly. We might have a worldwide depression. And I have come to believe over my career in life that experience is the very best teacher, and the worst experience teaches us the best lessons. And that causes me to have great concern. There was a pro-public article that came out recently, and over at HUD, there were 2 officials who believed that HUD needs to start using cryptocurrency, and that was actually a meeting, and they went into great detail on how this would function. And it would be a trial run, but wouldn't this be just another unregulated security into the housing market? Anybody?
I'll just briefly say that I think the dynamic you're highlighting actually relates to one of the reasons to be enthusiastic about stablecoins. Because of, and I think Mr. Guynn makes the points very clearly and well, because of the extremely tight controls about how stablecoin deposits can be managed, I think some of the duration mismatch and other fractional reserve related risks in the financial system can be significantly mitigated.
Okay, so HUD now wants to start doing their funding through cryptocurrency.
I don't know anything about the HUD specific dynamics.
Well, they are. I mean, that's kind of a fact, and so I'm concerned, just because of experience, that another unregulated security. And when you look at this sheet, you can't see it, I don't think. But this is Congressional Intergovernmental Relations staff. Right now, Ms. House, there's a move to shut down the CFPB, as I think everybody in the world knows. And their only job is protecting consumers. And if ProPublica didn't just make this up, and that HUD is planning on trying to respond to funding by giving them the funding through crypto, and we have all of these positions with HUD unfilled. Deputy Secretary, Assistant Secretary for Congressional Intergovernmental Relations, Congressional Relations Specialist, Congressional Relations Specialist 1048, Congressional Relations Specialist 10148. And we're talking about cryptocurrency. We don't have a staff. They're trying to shut down the whole operation of CFPB. I mean, don't you think somebody's having a nervous breakdown? I mean, I don't know. You don't have to tell me who's having a nervous breakdown, but
Yeah, I would, just to reinforce some of the issues that you've been highlighting about this, the need for us to make sure that we have strong consumer protections, and especially in a space like with stablecoins and other digital services, we're getting more and more reliant and interconnected on these digital services with even more data and more access and reach, and ultimately what that demands is a stronger capacity to be able to protect consumers. So ultimately, I don't think that it's wise to make arbitrary decisions to shut down things that are protecting consumers. If they want to drive more like effectiveness and efficiencies,
The gentleman's time has expired.
Apologies.
The gentleman's time has expired. The gentleman from Ohio, Mr. Davidson, Chair of the National Security, Illicit Finance, and International Financial Institutions Subcommittee, is recognized for 5 minutes.
Thank the chairman. Thank our witnesses for your testimony and frankly your work in the marketplace. It's inspiring, and I'm glad we're finally here today to talk about important legislation protecting, frankly, the ability to transact in the United States. And let's just begin with first principles. You know, in a state of nature, people can transact. The government isn't the giver of the right to transact. Does anyone believe that? Do we believe permission to conduct a transaction is given to us by the government? Okay, no takers. So it's a private sector right. It's a natural right. And in our country, that's kind of the way our country was founded, that we recognized our rights come from a creator, that among them are life, liberty, and the pursuit of happiness, and the Constitution protects them. And we're in a period where a lot of the debate about the regulation is, you know, how much control should the government have over the transactions? And the market has moved on. Stablecoins are a thing. They're not as big as we think they should be because they're less than 10% of all the market capitalization of all digital assets right now, but they hold a lot of promise. And for that reason, we're trying to get regulatory clarity beyond the state of New York and here across the nation, and frankly, with international agreements. Mr. Cascarilla, I appreciate your recognition of how important it is to add the ability to recognize jurisdictions that do get it right. But when we think first, let me just start about cash, because cash has been around for a long time, and you physically possess it in a permissionless way. You don't need permission from a government or even your bank to get it. Now, it's almost illegal to get your own cash, but not entirely, right? And financial institutions have an interest in preserving the deposits. They want all the stuff deposited. But at the end of the day, so do the consumers. They want the deposit. Some portion they protect. And I think that's why self-custody is important. And Ms. Butler, you've done a lot of work in custody of all sorts. How important is it for a permissionless transaction to be able to happen that we protect self-custody?
Thank you very much, Congressman, for your question. I think self-custody is a very interesting topic, and I think there's two things that need to be considered. The asset underlying, it's the custody, and the protections of asset safety. So if you can apply the asset safety protections in terms of segregation, in terms of AML and BSA, so you can protect the assets, then it's a customer choice, right? And I think customer choice is always going to be important when there's a variety of different options in the market.
Yeah, thank you. Mr. Collison, you guys are facilitating a large number of transactions, and certainly consumers and, vendors want to use your platform to do transactions. But some portion of that in the digital world, if you read the Bitcoin white paper, you don't have to go very far. The goal was to facilitate permissionless transactions, not entirely permissioned. How do you see self-custody fitting in that framework?
Appreciate your highlighting this. I think the self-custodial aspects of cryptocurrencies are, I think they're an important liberty, but also something that creates real challenges with respect to illicit activity and fraud and AML and so forth. With respect to stablecoins in particular, something that I think is helpful and I think has been highlighted here is that because of the on-ramp, off-ramp dynamic, you have these natural points where some degree of system integrity can be ensured and BSA and other requirements can be applied. But I think, to your point, there is a separate question as to how this should work with more traditional cryptocurrencies.
Yeah, thank you for that. And frankly, you have KYC responsibilities for your customers. And once they off-ramp it, just like cash, you might have some obligation to report that they did, but then you're not responsible for the entire network of money because, whatever US dollar coin's used for by anyone, well, you're only responsible for your customers, and we want to safeguard that. The nice thing to the point about what is it backed, we're here talking about stable coins, and stable coins are backed. Frankly, they're more secure than bank deposits. There's no fractional reserve lending against the deposits. It's one-to-one in a case of $1, and you don't have any liquidity or time period horizon, 6 months T-bills versus repo markets, reverse repo markets, with commodity-backed stablecoins like gold. It's a redemption of 1 ounce of gold claim. And so it's a very secure, you're essentially, by self-custody, signing ownership. Last thing, I definitely want to associate myself with Mr. Emmer's remarks on central bank digital currency. We don't want them to design it, develop it, implement it, or impose it. It is the polar opposite of the system. It is a system for surveillance, coercion, and control. We certainly don't want that form of money anywhere. And I yield.
Gentleman yields back. Ms. Beatty, the ranking member of the National Security Illicit Finance and International Institutions Subcommittee from Ohio, is recognized for 5 minutes.
Thank you, Mr. Chairman and ranking member. First, to all the witnesses, thank you for being here today. Ms. House, like you, I care about economic and technological security. I take very seriously the national security concerns posed by emerging technology and the unknowns that exist within the digital asset ecosystem. The existence of the digital market is not going to change, and the public appetite for it is not waning anytime soon, it appears. Like you, I agree that we need to establish mechanisms for victim resources and ways to track illicit funds and patch security vulnerabilities in smart contracts. It's clear that the current administration is going all in on crypto. The president and the first lady made over $1 billion on a Trump and Melania coin, defrauding his supporters on their hard-earned money and allowing him to make more money than he's ever in his past failed businesses. Eric Trump has also used his social media pages to promote coins, and he's invested in under the guise of good investment. To me, this is a direct example of fraud, market manipulation, and conflict of interest. Now, Ms. House, you noted in your testimony that pump and dump schemes endanger market integrity. So my question, how can we ensure the stablecoins uphold their integrity through regulation when the surrounding ecosystem is the wild, wild west?
Great. Thank you, Congresswoman, for the question. And ultimately, it's really the purpose of this hearing, putting in place as timely as possible the prudential framework that we need quickly for stablecoins, to make sure that we have the necessary protections for consumers to ensure the integrity of the asset. That means things like bankruptcy and resolution capabilities. It does mean things like one-to-one reserves, and also prevention of and the prohibition on rehypothecation of assets. So many of the protections that are outlined, some of them in the Stable Act, and more holistically in the Waters-McHenry bill.
Okay, well, while I have you, as the chairman mentioned in introducing me, I serve as the ranking member on the subcommittee of National Security, Illicit Funds, and International Financial Institutions. And as we know, cryptocurrency is the favored payment method for bad actors and criminals engaging in cybercrime, money laundering, sanctions, evasions, bribery, embezzlement, and I could go on and on with that. The stablecoin legislation that was negotiated between our ranking member and former Chairman McHenry included critical protections for anti-money laundering and counter financial terrorisms that we stripped in this Republican-led bills that we're considering today. Can you discuss the provisions in which the AML-CFT protections should be included in any stablecoin framework?
Absolutely, Congresswoman. Something I care very much about when I led crypto policy at FinCEN, our AML regulator. So I think what we need is certainly very clear guidance and expectation on the holistic framework for countering illicit finance. So that's both AML, CFT, and on sanctions applicability. So looking to things like extraterritorial application, that ultimately is critical, including for rewarding the good actors, many of which have been U.S. firms that have long been operating more compliantly versus others. We need to make sure that anyone who is purporting to be administering a U.S. dollar-backed stablecoin does not allow for U.S. dollars to become accessible to the greatest threats to our national security. So strengthening those provisions, making sure that we're clear about who is implementing those regulations and controls, and ensuring that they're as strong or on parity and equivalent to things like our banking requirements, and then also making sure that freeze and recovery capability is in place, which will help AML and also fraud and consumer recovery and recourse.
Thank you. As an expert, that certainly helps me, and for me it confirms or reconfirms that the Waters-McHenry critical protections that they were putting in their proposed legislation is something we really need. So hopefully, Mr. Chairman, you all would consider going back to what former Chair McHenry had proposed with Ranking Member Waters. Thank you, and Mr. Chairman, I yield back the rest of my time.
The gentlewoman yields back. The gentleman from Tennessee, Mr. Rose, is recognized for 5 minutes.
Thank you to Chairman Hill and Ranking Member Waters for holding this hearing, and thank you to our witnesses for taking time from your schedules to join us today. The Stable Act forges a path forward based on both innovation and accountability. While we have heard a lot regarding the innovation that this bill would unlock, I also think it is important to highlight the accountability that this brings to the stablecoin industry. The Stable Act would require reports regarding the stablecoin issuer's reserve composition to be publicly disclosed, audited, and attested to by the issuer's executives. Mr. Guynn, how will these requirements hold the stablecoin issuers accountable to the bill's reserve requirements?
Well, first of all, the market will be looking at these disclosures quite intensely because they're required monthly. So the market, in many ways, will impose a certain discipline on them. Also, the certifications, if they're willfully or knowingly misleading, they're subject to criminal penalties. So I think that would deter any CEO or CFO from making misleading certifications. I'm glad you asked that question because I kind of left off an important thing to one of the other questions on the disclosure. It's very important in the disclosure to be able to distinguish a payment stablecoin as being a very safe instrument that complies with this law, as opposed to something that might have the label stablecoin on it that may not actually be subject to the same standards.
Thank you. Mr. Guynn, you spoke about the success and clarity of the U.S. dual banking system. Under the Stable Act, issuers licensed by a state regulator must respect the sovereignty of other states who may choose to harmonize their requirements. Do you think this is the correct approach to a true state pathway? And what potential issues could arise if a state is able to preempt another state's laws?
So I actually think the scenario you're painting is probably very difficult because at least the way the Act is written now, there is a baseline of federal standards that are actually quite comprehensive. And to the extent there's a state level regime, it's required to equal or exceed the standards in the federal. So I think it'd be very difficult, for instance, it'd be very difficult for one state to say, I'm going to attract a bunch of stablecoin issues by having a lax regulatory framework. They just can't do it consistent with the Stable Act.
Thank you. I appreciate the insights. While blockchain-based solutions like stablecoins offer compelling new capabilities, traditional dollar payments will, in my opinion at least, remain dominant for the foreseeable future, likely accounting for the vast majority of transactions for years to come. However, our current system lacks many features that are being contemplated by the Stable Act and could be available with proper regulatory modernization and right-sizing. Mr. Collison, what do you think Congress should focus on when aiming to modernize the payments world?
Thank you for the question. So with respect to stablecoins, I think simply putting in place a clear framework with prudent rules for the road will do a tremendous amount of good. More broadly on payments, to your question, Stripe strongly supports the concept of some sort of federal payments charter. There is no single clear framework for payments companies like Stripe today, and we think that the federal government has a significant interest in ensuring that across our ecosystem, effective standards are upheld. And we also think that with access to things like the Fed's payment system, we can provide better services to businesses and to consumers. So I think federal regulation of the payment system could be very beneficial.
And so when you say a federal payments charter, you mean chartering institutions for that purpose?
Correct. Payments today are primarily, not solely, but primarily regulated at the state level, and that has a lot of benefits. We don't think that should go away. We think in addition to that, there should also be a federal framework.
Okay, thank you. The next decade will bring significant innovation in financial services and products. These innovations will require regulatory clarity and appropriate risk-based supervision, matching how payments work in a digital economy. Mr. Collison, the same way that a stablecoin charter will jumpstart stablecoin innovation, what would a payments framework do for the modern economy?
There are analogs to the payments charter in other jurisdictions like Europe, Canada, other places as well. We can see that this works well in practice. And in places like Europe, they've been an incredible stimulus for vibrant innovation in consumer financial services broadly. And I think I recognize that the time is about to expire here, but I think there are many ways in which this would be helpful in the U.S.
Thank you. If you'd like to expand on that off the record, I'd appreciate it. Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Illinois, Mr. Casson, is recognized for 5 minutes.
Thank you. I appreciate you all being here. I want to start a little wonky. There's been some academic discussion sort of linking stablecoins to Eurodollars as something that exists outside of the normal payment system. And Ms. Butler, I just want to start with you. Do you agree that the U.S. correspondent banking system, as it sits right now, has sufficient guardrails to make it difficult for illicit actors to access the global dollar system?
Thank you very much for your question, Congressman. I do believe that the rules that we operate today in the traditional banking services, including corresponding banking, are applying the right safety guards and rules.
Okay, and I agree with you. I raise that because stablecoins, as they're structured right now, do not have that same sort of nexus of control, right? They can hop across the river, if you will. They can be transferred on public blockchain networks. There's no central operator, no entity. Ms. Howes, I think you had alluded to some of this in your testimony, and I wonder if you could just share with us how you think Congress should address that gap in our sanctions and anti-money laundering networks so that stablecoins don't just become a backdoor for the bad actors to get into the U.S. dollar system.
Thank you, Congressman, for the question. I think that the most, you're right, that I started on the earlier answer. But basically, the most important provisions, I think, that are necessary are making sure that the issuer and the administrator of the stablecoin is implementing some AML requirements, and especially for sanctions requirements, making sure that we're not facilitating transactions denominated in US dollars to sanctioned jurisdictions and sanctioned wallets, which is happening right now. So making sure that freeze and recovery capabilities are in place, and then making sure that the US dollars are not being made accessible to the greatest threats to this country.
Okay. And Mr. Guynn, you'd alluded earlier to saying that, when some of the algorithmic stablecoins that had broken the buck, if you will, unless I missed it, you didn't mention the fact that the most recent breaking of stablecoins was when SVB and Signature Bank runs happened and you had a bunch of stablecoins that were sitting there in uninsured deposits. Is it your position that any liquidity that's in cash deposits should be absolutely 100% insured?
So it's interesting. I do think that
I'm just looking for a yes or no because I want to get through a couple things.
I don't know that I have a yes or no to that. I think that one has to be more careful with uninsured deposits. In the SVB had 95% of its deposit uninsured, so it was
well. If we have liquidity underpinning these things, like stablecoins need to be boring to work. We don't want fractional banking and blow this thing up. And Ms. House, correct me if I'm wrong, dollars deposited in European accounts are not insured by the FDIC, correct? I want to turn now to the fact that we just witnessed the largest cryptocurrency heist in history when North Korean hackers stole $1.5 billion from Bybit. Mr. Cascarilla, I understand, maybe you can just share, what is Paxos' policy for freezing funds that have been used for illicit activity?
So we have a couple different guardrails in place. The first is we have terms and conditions that set forth how we could freeze and then seize funds, which we have done in the past. We also have this overseen by a prudential regulator. When we receive a subpoena from a lawful jurisdiction, we can freeze the funds, and when that's adjudicated, we can seize them.
So is your policy that you will freeze them only if a regulator directs you to, or will you take proactive action to seize them as well if you detect illicit activity?
We will contact a regulator when we've seen illicit activity. An example would be our Pax Gold product. When we saw it moving after the FTX collapse, we contacted our regulator. I think it was the DOJ, actually.
But I just want to understand, because we're all Americans here. If you knew that North Koreans were laundering money to finance their nuclear program and the regulator had not yet said to stop, would you shut it down immediately, or would you wait for someone to call you?
We have these conversations in real time with the regulator, so we would, of course, talk to them and make sure that we were doing it appropriately.
Okay, well, all of us, if we're participating in the banking system or want to participate in the banking system, need to address that. Given the speed at which some of these people go through, particularly, right? Because it's one thing to say we're having real-time conversations, but I mean, these things can hop through in an instant. Running through mixers, running through DeFi protocols, chain hopping. Ms. Howes, does Congress need to consider requirements to, at a minimum, make sure that stablecoin issuers have the technological capabilities to freeze these funds, and that stablecoin issuers are compelled to act proactively, not just after the horse is out of the barn?
Absolutely, yes, sir. And to a certain extent, I think that they already are obligated to do that. Sanctions carry strict liability, and AML programs require a reasonable program to detect and prevent money laundering through their systems. But those things need to be enforced, need to be clearly articulated and implemented.
Okay, I'm about out of time, but I just want to say to the whole committee, stablecoins, A, have to be stable, B, have to be structured not in ways that would destabilize the global financial system, and C, should not provide a backdoor to money laundering. And I hope that any legislation stays true to those three principles. Yield back.
Gentleman yields back. I now recognize myself for 5 minutes for the purpose of asking questions. I thank all of our witnesses for being here. It's exciting. We're in the golden age of digital assets, and we have a huge opportunity to move forward on two really important pieces of legislation in this committee and to see them ultimately signed into law, in particular stablecoin in market structure. I want to dive in a little bit on the stablecoin legislation. And I'll start with you if I can, Mr. Collison. I believe that stablecoins in particular give us a real opportunity to maintain dollar dominance across the globe. We've talked a little bit about use cases, and as a policymaker in general, I might not be concerned about the way that someone in Mexico, Panama, Peru, Nigeria, or another location is engaged in transactions. But what we actually see is when Stripe has a neobank in Mexico or Bridge is used to distribute payments to workers across Latin America, that actually strengthens the US dollar. Would you agree? Can you comment on that briefly?
Yes, I think it strengthens the U.S. in two ways. One, many of the companies engaged in the activity you're describing are themselves American businesses, and so they become stronger. But secondly, and I think this is what your question is getting at, it increases dollar demand, it increases the demand for U.S. treasuries, and it in turn lowers U.S. borrowing costs.
Thank you very much. I'm going to come over to you if I can, Ms. Butler. Sometimes you'll hear people say that the banks don't like stablecoins don't like the bank. You all get this back and forth. But BNY Mellon's very engaged in the stablecoin space. Could you just put a little color as to what the value proposition is to your customers at your bank?
Thank you very much, Congressman. Yes, indeed, there is a number of different things. So first, the value proposition in the kind of near term is providing trust and security to stablecoin issuers as the reserve custodian. We also manage many different types of payment vehicles, so whether it is the instant payment vehicles provided through the Fed and a variety of different options for our clients. We want to be able to participate in the new and evolving options and mechanisms, stablecoins and blockchain technology just being an example of that, so that we can continue to meet the evolving needs of the market and our clients.
Thank you very much. I want to come to you, Mr. Cascarilla, if I can, to talk about how do we make stablecoins stable. In the updated draft that Chairman French Hill and I introduced, we were tweaking the language of what can be held by a stablecoin to back it. Could you provide a little bit of color based on your experience about stability, liquidity, and investor confidence in the Pax dollar and what you're backing that with and what we should be looking at?
Yeah, we've issued a number of different regulated dollar tokens. They all have the same exact reserve parameters, and generally having a maturity of less than 20 days, having overnight liquidity available through overnight repos that are over-collateralized by treasuries, plus having T-bills, and minimizing the amount that's held in bank cash, and where possible, buying private insurance to supplement FDIC insurance. And when you do that, you basically have, I think, the safest dollar in the world. It's safer than a dollar in a money market fund. It's certainly safer than a dollar that is above an FDIC limit in a bank. And I think that creates the confidence to be able to use a stable coin as if it's cash in your pocket, and that's the whole point.
Thank you very much. I want to use the remaining time that I have. I want to just touch base here with you, Ms. House, if I can. You were commenting earlier about the importance of AML, BSA, AML. Could not agree more with the importance of it. I think the question then is what policies we put in place to get this right. And I think in part, my big concern here is that we let perfection be the enemy of the good. What I mean by that is across the globe, people can engage in illicit behavior regardless of what technology is being used. And so if we think about when the Obama administration in 2016 sent literal pallets of cash to Iran, the first shipment, I think, had $400 million in pallets of actual cash, went to the Iranian regime. An amazing and disastrous policy decision, in my personal opinion, but remove the commentary, let's just analyze the cash. What controls were in place to track that cash once it left U.S. custody and entered the custody of Iran? Any?
Honestly, I wouldn't be familiar with that. I was in the Army.
But in general, you're familiar with cash. Would there be any
yeah.
tracking mechanism in place as that cash floated around the country of Iran?
It'd be very difficult.
It'd be really, really difficult, right? So if Iran was taking literally those pallets of cash provided by the Obama administration and was doing something illicit like funding terrorism, we know Iran is one of the, or probably is the number one funder of illicit finance. That's a really bad scenario. So although we could pick and choose and critique other legislation, we know actually that stablecoins is a major step forward from cash transactions, and I think we need to make sure that we don't allow perfection to be the enemy of the good. Recognizing the time, I yield back. I will now recognize the gentlewoman from Michigan, Ms. Tlaib, for 5 minutes for questions.
Thank you so much, Mr. Chair. Can everybody on the panel, do you all agree that market manipulation is bad? Raise your hand if you agree market manipulation is bad. Oh, great, okay. I want to get to conflict of interest. And Ms. House, I don't know if you know about this, but I want to talk about a billionaire crypto entrepreneur, Justin Sun. In March of 2023, the SEC charged Sun with market manipulation. Last year, Sun began investigating millions of dollars he started investing millions of dollars in the Trump family crypto business. They call it World Liberty Financial. Are you familiar with Trump's crypto business?
Yes.
Yeah.
Yes.
So he starts putting money into that. And then in total, I think Sun's investment have put more than $50 million. Now not 1 million, not 2, $50 million in Trump's pocket. Then just last month, poof, SEC announced that it was dropping its charges against Sun. So Ms. House, how is this not a conflict of interest? Do you think those who are regulated by, and in some cases investigated by, federal regulators should be able to invest ventures directly benefiting the President of the United States?
On the second question on whether that they should be able to, and if that's conflict of interest, it definitely sounds like it, and that there should be protections there. And I encourage those responsible for forcing them to look into it. And then on the first question about it, I would say I would go back to my earlier comment that when we are in government, we hold a sacred duty to uphold the public trust, and that we need to make sure that we're held to a higher standard, and we need to make sure that we uphold.
Yeah, I mean, we have the Emoluments Clause. You would think that the President would have no idea that it's in the Constitution and that he's violating it. So then there's the meme coin. Just days before he's sworn in, the President, he issues his own meme coin. While investors suffered more than $2 billion in losses, Trump and his partners made $100 million on trading fees alone. Now the SEC has declared that the meme coin is not subject to oversight. It's now dropping crypto cases and investigations left and right, even where, check this out, even where the CEO already pleaded guilty, they dropped the charges on them. So Trump and Musk have also gutted the CFPB, as you know, Ms. House, and the CFTC has announced that they're meeting directly with crypto CEOs to further reduce regulations of crypto. So Ms. House, yes or no, does the President Trump stand and benefit when none of the regulators are providing rigorous oversight of the crypto market? He benefits personally, right?
It sounds like the financial interests may, although I will say that there have been instances where more regulation and clarity have benefited the market also. So
the President of the United States has no oversight over this meme coin, all this investment right now, none. Does the fact that foreign nationals, Ms. House, have invested in Trump's meme coin and other crypto businesses have national security implications? Foreign nationals have invested in the meme coin.
There's certainly, I think, sorry, I'm not an attorney, so I recognize that there's legal implications there, but I would say that there's definitely some hallmarks of concerns about influence and where it makes sense for those with the authority like those in this room to look into this in a bipartisan way.
During the last election, the crypto industry spent over $130 million backing Trump and others. It looks like that investment is paying off to me. I mean, $130 million. Last week, President Trump issued an executive order creating a strategic reserve of cryptocurrencies. Ms. House, given that President Trump has a personal stake in the success and the perceived legitimacy of crypto industry, is this not a conflict of interest? I mean, he's in the industry and he just did an executive order.
Roger, it definitely sounds like that, like there may be conflicts of interest, and again, I hope that the offices with the authority for oversight, like Office of Government Ethics and Congress, consider looking at that. I know, obviously, I had a bank account and we still regulated banks, so there are other places, but ultimately, for an industry that is highly speculative, there's a lot of questions.
Ms. House, given that interest of the President in the crypto industry are so closely aligned, how can investors trust that their interests are prioritized by financial regulators?
I think the trust there needs to demonstrate, that regulators need to demonstrate dispassionate putting in place of the guardrails that will protect them, that will protect consumers, and that are going to benefit the American public, and not appear to serve only public officials or those who are in. I think that there's a great opportunity here with stablecoin regulation to do both.
Thank you. I yield.
Gentleman yields back. The gentleman from Indiana, Mr. Stutzman, is recognized for 5 minutes.
All right. Thank you, Mr. Chairman, and thank you to the panel for being here. Mr. Collison, I'd like to come to you. You built quite a family business. Congratulations. And to have your dad with you is pretty neat. I come from a family business background as well and work with my family. And some days it's great, and some days they're my family. But I wanted to go to your testimony because I see, as you wrote in your testimony back in 2014, that you put a pause on supporting the Bitcoin, and you saw limited demand, and but then you kind of relaunched it again with Stripe we did the stablecoin pay-ins in April of 2024, and that you saw more volume in stablecoin payments over the first week than you saw in Bitcoin over a year and a half. Can you talk a little bit about that? Like, what do you think that was and why?
Yeah, it was wasn't very popular in the Bitcoin community when we sort of removed support from Stripe, but that wasn't because of any ideological principle or position. We're very responsive to what our customers want and what we observe user behavior as trending towards, and we saw declining usage of Bitcoin. Again, back in 2014, it was a very different time. And so we've obviously been paying close attention to the ecosystem, and the world is becoming more densely connected and globalized. The crypto ecosystem has matured substantially, and we've been very struck, as you mentioned, as we've gradually over the past 2 years or so rolled out new support for stablecoins. That there's very real usage, there's very real appetite, and again, we're seeing use cases outside of what one might traditionally consider the crypto industry, and it's really expanding into the economy as a whole.
I also want to touch on your, down later in your testimony, you say that stablecoins enable faster, cheaper money transfers for international workers. You touched on that a little bit. Are you seeing global activity, like in emerging markets? I mean, Africa is a place that I believe that the world is looking at for stability and opportunity. What are you seeing within your company and the activity around the world?
Yeah, so I understand that exhibits are discouraged, so I'll just note that I have a little chart of the Naira USD exchange rate here. And over the last 15 years, the Nigerian Naira has depreciated by about 90% against the US dollar. There's a lot of people in Nigeria, and they very understandably want access and recourse to stable savings and some secure way to store their hard-earned money. And so we're seeing substantial adoption across jurisdictions like this, where people are seeking to improve their lives and their livelihoods with what stablecoins make possible.
Yeah, and a little bit further, you talk about fighting crime and online fraud, which obviously we're all very, very concerned about that. And you mentioned that we see other countries, especially in Europe, already putting their legal framework into motion to regulate stablecoins. Can you touch on what are they doing that we're not?
Well, I think the most important thing is simply having a clear, established, formalized framework, and that's by far the most significant consideration. And then I think the second aspect, and in particular to the fraud and illicit activity considerations you bring up, is recognizing that this is a new transport layer for money, but ultimately it's still the same money. And so we should bring and apply the same AML, CFT, BSA considerations and apply them co-equally here, but it's still money.
Yeah, very good. Mr. Guynn, I'd like to come to you. Fortunately, this committee is aligned with the great state of Indiana and President Trump in its opposition to a CBDC, and has taken several steps to facilitate development in private sector alternatives. In your view, would a private sector-driven model for payment stablecoins foster more innovation and efficiency than a government-issued CBDC?
So I think the private sector has always been the innovator in money for centuries, if not longer. And so I think that fostering private innovation with stablecoins is very important and critical.
Would you have any concern of monopoly at all?
I don't see any now. I think it is best for Americans for there to be a lot of competition among stablecoin issuers. So I think having a clear framework and clear pathways to entry is the best policy in order to foster competition.
All right. Thank you. Mr. Chairman, I'll yield back.
Thank you. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Mr. Chair. No technology should be judged solely by its abuses or worst possible uses. Every technology has constructive uses and destructive uses, and crypto is no exception. Take as an example the automobile, which has a death toll of more than 40,000 Americans every year. The proper legislative response to the automobile is not to ban it, it's not to sabotage it, it's to regulate it, it's to make it safer. And as far as I'm concerned, the proper role of Congress is not to sabotage digital asset transactions, but to make them safer, to strike a careful balance between financial stability and innovation. There is a narrative that crypto and blockchain have no use cases beyond criminality, no benefit, that these technologies are nothing more than a fraud and a grift and a scam, right? That's the caricature of crypto that often pervades mainstream media coverage. And so I have a few questions about the use cases of crypto. I'll start with Stripe. Does blockchain, and these are yes or no questions, does blockchain have the power to enable better, cheaper, and faster payments and remittances?
Yes.
Would you consider that a beneficial use case?
Yes.
For Paxos, there are billions of people in the global south who lack access to a stable currency, whose countries are plagued by hyperinflation. Does blockchain have the power to afford those impoverished people access to a stable currency and protection from runaway inflation?
Yes.
Would you consider that a beneficial use case?
Yes.
For Stripe, does blockchain have the power to exponentially expand the market for U.S. treasuries and lower the cost of U.S. debt?
That's certainly what it looks like today.
Would you consider that a beneficial use case?
Very much so.
Bank of New York, does blockchain have the power to tokenize real-world assets and facilitate custodial banking?
Yes, it does.
Would you consider that a beneficial use case?
Absolutely.
Now, Bank of New York is the bank of Alexander Hamilton. It's the oldest bank in the United States, the ultimate expression of the traditional financial system. I imagine you're obsessed with regulatory compliance. As the oldest bank in the world with more than $50 trillion in assets under custody and administration, would the Bank of New York waste its valuable time and resources and reputation on a technology that had no use cases beyond criminality? Does that sound remotely plausible?
No, we would not.
Now, tokenization is becoming the future of the global financial system. And as more and more assets become tokenized and more financial transactions become blockchain-based, does the lack of regulatory clarity around blockchain put the U.S. at risk of losing its financial competitiveness? Bank of New York.
Yes, it does.
And if the United States had gotten internet regulation wrong, do you think the United States would have gone on to dominate the internet-based financial system that eventually emerged, Stripe?
Very hard to say, of course, but quite plausibly not.
So it would stand to reason if the United States gets blockchain regulation wrong, do you think the U.S. will go on to dominate a blockchain-based financial system that might ultimately emerge?
No, I don't think it will, and we've already seen some evidence that if the U.S. doesn't move here, the nexus of activity will move elsewhere.
So as far as I'm concerned, in order for the United States to remain the superpower of the world, we must embrace emerging technologies. We must harness the power of emerging technologies to make America more productive at home and more competitive abroad. And any policy that has a chilling effect on experimentation with new technology could erode American competitiveness. I had a special hatred for SAB 121 because it essentially had the effect of prohibiting an institution like Bank of New York from even experimenting with blockchain technology. And I feel we in Congress should have the intellectual humility to recognize that digital assets will develop use cases that none of us can foresee. And since there are limits to what we can know about the future, it's incumbent upon us as policymakers to foster a flexible and nimble regulatory environment that allows for the development of a new technology and allows for experimentation with an emerging technology. Telling an institution like Bank of New York that you cannot even experiment with blockchain technology is the worst thing we can do for American competitiveness. What are your thoughts?
I appreciate the point, and I think it's important that we continue to innovate within the safety and soundness of the financial system. We need to do both, right? We need to innovate and we need to protect the system. And absolutely, we should have the the clarity of rules to enable us to do that. And we should welcome competition, right? That competition drives our economy and enables the right types of outcomes for all consumers in the marketplace.
I see my time has expired. Thank you.
I now recognize myself for 5 minutes. First, I want to thank the witnesses for being with us today. I also want to align myself with the comments from my friend from New York, Mr. Torres. It is fantastic that this has become such a bipartisan issue. With multiple executive orders and last weekend's discussions at the White House Crypto Summit, it is clear that President Trump is making regulatory clarity in the digital asset space a top priority. Now, Congress must follow through by passing legislation that cements this framework into law, ensuring that years from now, neither rogue senators nor power-hungry SEC commissioners can stifle American innovation. As President Trump and many on this panel have emphasized, maintaining U.S. leadership in digital assets, from stablecoins to tokenization to the future of blockchain, It's critical to our economic success and our future. A strong legislative framework will give entrepreneurs, investors, and businesses the certainty they need to innovate without fear of regulatory overreach or shifting political agendas. Without clear laws, the digital asset industry remains vulnerable to arbitrary enforcement actions that stifle growth and push talent overseas. Now is the time to act before regulatory uncertainty drives the next wave of groundbreaking technology to other countries. Mr. Cascarilla, how would clear and favorable stablecoin legislation affect the U.S. position in the global digital asset market, particularly in competition with regions like the EU and Asia?
I think the most important thing to remember is everybody wants a US dollar all around the world. And the dollar is a product, in a sense. And in order for the product to continue to be usable in an internet-based economy, you have to make it work on internet-based rails, which is why blockchain is so important. And if the US doesn't do that, then other countries will, other currencies will, and if you have the right frameworks to create trust and more ubiquity of adoption, then inevitably they could gain the reserve status that the US has now. And that's, I think, something the US should want to avoid.
I couldn't agree with you more. One follow-up for you. What are the most promising real-world applications where stablecoins are already being used in favor of traditional banking functions? And how can these models be scaled to include those who have been left out of traditional finance?
Well, right now, all you need to have is a wallet on your smartphone in order to be able to hold a blockchain-based dollar or a stablecoin. And that means that people all over the world who don't have access to the traditional financial system, who don't have access to a bank account, which, by the way, is billions of people, can now have access to the US dollar. And they want the dollar because most of those people who are unbanked or underbanked are potentially and very significantly in countries that have depreciating currencies, as Patrick was pointing out.
I'm going to follow up on that. So I kind of see this future where autocracies that use controlling their banking system as a means of controlling their population as being challenged by this future and the future of digital assets. Do you agree that that's something that authoritarian governments are going to have as a challenge in the future once this becomes more commonplace?
Absolutely, and that's why I think it's so important to recognize that you're not just exporting dollars, we're exporting American values. And everyone wants a dollar. They also want America. They want to be able to have access to our financial system and to our assets, and we should take advantage of that by making sure that we can give it to them in a way that actually has true utility for where the economy is going.
In addition to digital assets challenging authoritarian governments, I do believe that Starlink has potential to disrupt authoritarian governments' control of information. So I think that the future that these technologies can provide us has the potential to really reshape global politics for the better. Mr. Collison, how do we ensure that payment companies like yours are able to serve all types of businesses, no matter the uncertainty in Washington?
I think that so long as there are clear regulatory frameworks in place and that those frameworks are stable, I think that the financial ecosystem as a whole is going to focus its efforts on serving American consumers and businesses.
Thank you for that. In my view, this committee's most important role in the DeFi space is to create stability and consistency in the market for stablecoins and tokenized real-world assets. For years, the digital asset sector has suffered from the constant swings of the political pendulum. This uncertainty only harms American innovators and weakens the U.S. economy and marketplace. As Congress, we must use stablecoins to set clear precedent. Regulatory clarity is coming for the digital assets industry. President Trump has made this a priority, and we must follow through to ensure that blockchain innovation has a strong foundation here in the United States. By taking decisive action now, we can solidify America's leadership in the global digital economy for years to come. With that, I yield back, and the gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, and thank you to all the witnesses here today, especially the two from Ireland. We'll remember you next week. Mr. Chairman, I think we should have had him here on St. Patrick's Day rather than today. It would have been more fun. As you know, cryptocurrencies have the capacity to expand financial inclusion and bring digital assets to historically marginalized communities, much like those in my district. Despite this, for the average American consumer, all this is seen as very overwhelming, and some of them quite don't understand what the crypto stuff is all about. It feels like there's, especially when there's a new stable coin or cryptocurrency created, it seems like almost every day. The market continues to be unregulated, vulnerable to stablecoin runs and hacks. Aside from the structural and operational risk, most stablecoins do not offer enough consumer protection. I think, Mr. Collison, you mentioned that the need for transparency and consumer protection is, so has Ms. House. So Ms. House, if an issuer fails and there's no protection, what happens? What are we dealing with with people's hard-earned dollars? I'm not talking about investors. I'm not talking about the millionaires or billionaires that are investing. I'm talking about the average American. Why is strong regulation and enforcement authority critical in this stablecoin legislation to protect them?
Thank you, Congresswoman, for the question. It's entirely critical to protect everyday Americans, especially the people that the cryptocurrency industry wants to provide democratized access to financial services to. In order for them to do that safely and securely, they need to have a way other than do your own homework to know that a stablecoin is in fact stable. And they also need to be able to trust that they're going to have recourse if they get defrauded or if they get stolen from, and to be able to believe that there's going to be this means for redress, which isn't possible without a comprehensive regulatory framework in place, enforced, and that we do the same with our international partners, given the global reach.
Because, I keep hearing, and one of the things that they've always used as a reason to really, explore this whole option is replacement of remittances. And as coming again from a 77% Latino district that does use remittances and other forms of ways to transmit money to their family members, is that really real? I mean, I just don't see, someone in my neighborhood going somewhere to use crypto or to transmit, not knowing what's going to happen at the other end, because just quite frankly, as there's risk in the banking system in many countries, there will also be risk in the crypto industry.
Roger, I think that the point that you're speaking to is really why we're seeing most stablecoin use happening in settling trading on platforms rather than facilitating these remittances. We haven't created the ecosystem for that trust. If a regulatory framework allows for that trust and for the people in your neighborhood to believe that if they send these remittances of their hard-earned funds overseas, that money isn't going to be, isn't going to be defrauded, or it's not going to be stolen from them. If they trust this ecosystem, then they may start using it. But that business case has yet to prove out. I think that the regulatory framework is actually a precondition to allow for that mass adoption.
Right. We saw in the 2008 financial crisis that extraterritorial reach was needed to help regulate the impact that foreign institutions may have on domestic markets. 2 out of the 3 proposed stablecoin bills lack extraterritorial reach and fail to address national security concerns. Given the global nature of stablecoins in this sector, the question is whether to regulate cryptocurrencies on a state or federal level.
In my view, the federal level has to be involved. I support the state level happening and there being kind of a partnership, again, reflective of the McHenry-Waters bill that made room for there being partnership and the role for federal agencies in creating the standards. But given the global reach and given allowing for global instant access payments and specifically purporting that these assets are a dollar substitute or representing a dollar, it makes sense that federal regulators would want to have oversight into these assets, especially when they reach potentially systemic risk levels.
Do you see that we can really get to that balance of having, again, the broad federal regulation and then still allow states to do some of the things that, some of our state banks do?
Yes, ma'am, I do believe so.
You do? I've got 7 seconds quickly. In your opinion, who should oversee stablecoin issuers of less than $10 billion?
The federal level should have oversight. But it makes sense for states to run the charters, just with some conditions for when the federal agency oversight comes to play.
What about for non-bank issuers of less than $10 billion?
I think state charters and licenses would be appropriate.
Gentleman's time has expired.
Time has expired. Thank you.
The gentleman from Pennsylvania, Mr. Musier, is now recognized for 5 minutes.
Thank you, Chairman. Thank you to you all very much for being here. It's a very worthwhile hearing and really important. So stablecoins, when properly regulated, can provide faster, more efficient payment options and help keep the U.S. dollar at the forefront of global financial systems. They can accomplish these goals without the privacy and free market concerns associated with a central bank digital currency. WIP-EMER as we know, has introduced the Anti-CBDC Surveillance State Act that protects Americans' privacy by preventing the direct issuance of a CBDC, which I did co-sponsor. As well, states have taken different approaches to regulating digital assets. This patchwork, however, has gotten the stablecoin ecosystem to where it is today, but if we want to see the benefits of payment stablecoins nationally, Congress needs to act. We need to enact a federal framework for stablecoin issuance. So, Ms. Butler, BNY is one of the oldest and largest custodians in the world. Can you describe how custody in the traditional financial system differs from custody in the payment stablecoin ecosystem?
Thank you very much, Congressman, for your question. It doesn't differ because the custody that we provide for the reserve assets of a stablecoin, for example, taking cash deposits and then taking non-cash securities into our custody, applying asset safety and segregation rules, is the exact same that we would do for the traditional custody that we provide.
All right, great. BNY Mellon, of course, holds reserve assets for major stablecoin issuers like Circle. How did BNY Mellon and Circle decide to form this partnership, and what custody standards were agreed upon to ensure that Circle's reserves were securely held?
So again, our custody standards were the same long-standing standards that we have for all custody that we provide globally around the world. In terms of deciding to take on the custody reserves for Circle, we followed our practices of business and risk framework. We looked at the client, their legal permissibility, their regulatory coverage. We looked at the activities that they were performing and were those activities legal and permitted. And we looked at the assets themselves, and in this case, given the assets are very traditional assets, so again, cash and cash equivalents, that fit right into the standard custody that we provide.
Okay, great. So clearly, you believe it is important for banks and non-banks to have the same custody rules for stablecoin reserves.
We do, yes.
Okay, great. Thank you very much. Mr. Cascarilla, many argue, some anyway, a U.S. Less than the majority, shall I say, the CBDC could strengthen the dollar globally. But they, of course, raise concerns about privacy and free market competition. How does a payment stablecoin approach these concerns differently?
I think the important point with the payment stablecoin issued by private issuers is that you're creating the innovation to respond to the market in a very timely manner. And we're still at a very early stage of the market where there's a lot of innovation that is still needed. I think that there have been some examples of attempt for CBDCs to be issued by other countries, and they've been perceived as surveillance coins and have not been widely adopted as of yet. And I think that could potentially be a limitation to the U.S. being able to successfully issue a CBDC.
Can payment stablecoins strike a better balance between preserving individual privacy rights and maintaining the dollar status as a leading global currency?
I agree with that.
You agree we could find a better balance?
I think that the right balance is to make sure that the private sector is leading and being able to create the innovation and being able to make sure that it's responding to the market as fast as possible. And I think that's going to be done from the private sector.
Do you think the protections are then enough within the Stable Act and 521 for that matter?
I do think that they are fit for purpose. I think that they have the right BSA AML rules as well as the right reserving requirements and the right international reciprocity can be put into place to make sure that the U.S. is setting the standards that everyone follows.
Okay, thank you. Mr. Guynn, in states like Pennsylvania, for instance, digital asset regulation is limited to money transmitter licensing. State regulators often want federal guidance on emerging technologies, but also prefer to maintain their own authority. How does the federal floor concept in the Stable Act ensure consistent national standards for stablecoins while still respecting each state's ability to regulate according to local needs?
Yeah, so I would say that the states have more flexibility in the dual banking system to have alternative regulatory frameworks. There are federal minimum standards in the banking, but they only cover a small part of the activity. Here it's pretty comprehensive. I think it would be very difficult for a state to do much other than increase standards if they wanted to do so.
Okay, great. Thanks very much. Mr. Chairman, I yield back.
Thank you. The gentleman from California, Mr. Liccardo, is now recognized for 5 minutes.
Thank you very much. I appreciate the progress in the political discourse over stablecoin. I represent a district that includes half of Silicon Valley, and obviously we have a different view from many about certainly the importance of this technology, and I appreciate much of the testimony I've heard so far. I also appreciate we've moved from discussing whether to regulate to how to regulate. That's an important progression, and I want to thank my colleagues on both sides of the aisle for their hard work. And I think as we look at, for example, in the Stable Act, we have protections that would require issuers to abide by standards relating to AML, to Bank Secrecy Act, mandate one-to-one backing, cash and cash equivalents, enforcing transparent redemptions and audit disclosures. Those are all very important requirements. But my concern is we're in a world where we know issuers are out of the country. In fact, Tether, the largest, I understand, for U.S. dollar-linked stablecoin is in El Salvador. And I'm trying to understand why we wouldn't want those protections globally, given that the U.S. dollar, of course, is going to be linked to much of the stablecoin. And, you know, particularly, I would appreciate your comments, Mr. Collison, and in your testimony, in the written testimony, says the U.S. should move quickly and seize the opportunity to lead on global standards of stablecoin and payments regulation, reinforcing dollar dominance, ensuring American companies remain at the forefront of financial innovation. And typically that includes a sense that our regulatory structures will also be the leaders, as they have been, in financial regulation globally. And so I guess I wanted to go to you first, Mr. Collison. And by the way, I appreciate, I think you were born in Tipperary County, where my grandmother was born also. She also managed to make it to San Francisco. So you're on a well-trod path.
I was far from the first Irishman in San Francisco.
Yes, that's what I noticed. My question is, wouldn't your customers want to know that there was extraterritorial enforcement and the capacity for the United States to be able to enforce beyond its borders?
I think on the margins, they would prefer that for all the reasons that you're saying. I think in practice, they're so enthusiastic about the quotidian benefits they can realize, they're probably not going to block on that. But if you ran a survey of them, yes, I think so.
Could you help me understand, I know you don't speak for the whole industry by any stretch, why wouldn't we want to have extraterritorial enforcement?
Well, I think there's probably some degree of devil in the details, right, as to what precisely the nature of that framework and enforcement would be. And to the analogy of states being the laboratories for various forms of innovation in the US, there's probably some degree to which we don't want an excess of global cohesion, precisely because there should be some degree of variation permitted. But I think it's the case that any stablecoin failures anywhere, and by the way, I think it's helpful just in the conversation generally to separate to some extent crypto from stablecoins. They're of course related, but I think there are important differences. But I think all stablecoin and again, even crypto failures in any part of the world, they don't look great for the sector. And so in as much as global frameworks can inhibit that and make it less likely, I think that's beneficial for everyone.
Yeah, I appreciate your candor. My concern is I know this is a concern that's shared on both sides of the aisle. We want to make sure that American sanctions are abided by and that U.S. dollar-linked stablecoin is not used to evade sanctions. We want to ensure that anti-money laundering provisions are enforced globally. We want to ensure that terrorism isn't funded through stablecoin. We know it can be funded by any currency as well. Certainly, this is not unique to stablecoin. But I hope that we can work across the aisle to ensure that this bill could be improved with extraterritorial provisions. Thank you very much. I yield my time.
Thank you. The gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Thank you, Chairman. I appreciate the witnesses for joining us today. Let me ask my first question to Mr. Collison. According to Stripe's own annual letter and your testimony here today, your company processed $1.4 trillion of payment volume just last year, 2024. That represents roughly 1.3% of global GDP, and that's significant. So as we explore emerging technologies like stable coins, the vast majority of the economy still relies on dollar payments. This is an industry that is currently regulated by the state-by-state patchwork that is designed that's designed for a pre-internet era, and that creates unnecessary friction and costs that ultimately affect American consumers and businesses. So can you talk to us about how Congress can think about solutions to those issues?
Thank you for the question. I think that providing a clear framework for stablecoins that enable U.S. businesses and U.S. consumers to realize some of the benefits of cheaper and faster and more efficient and even more innovative transaction technology will be, I think that'll be extremely beneficial, and I really appreciate Congress's curiosity in exploring this issue and the kind of bipartisan nature of this discussion. Beyond that, I think that looking at the payment system more holistically and broadly, possibly up to and including a federal payments charter construct, would be a very helpful either complement or maybe succeeding action to stablecoin legislation. But I'm really glad that the proposals under consideration here today are being
Can you also talk about some
seriously.
of the challenges that this will bring to the industry? Some of the challenge that this approach that you're talking about.
Oh, that the patchwork brings. I see. So I think I think one of the most inhibitory forces in the financial services industry is ambiguity and a lack of clarity. In that if something is clearly permitted, that's great. If it's clearly forbidden and proscribed, that's also, it's clear. One can, build a business and one can plan around that. I think the current patchwork that's, not very cohesive makes it difficult for businesses to know how seriously they should invest. And I mean, I think it's very admirable that BNY Mellon has built such a successful practice here. But I think it should be easier for others to do the same thing.
Let me ask my question to Mr. Cascarilla. My home state of California is a leader in issuing remittance payments, and in 2022, Californians sent over $18 million in remittance payments to Latin America. However, our modern-day system of payments can make dollar transfers abroad costly and time-consuming, and it can lack the appropriate legal oversight. So that is why, obviously, we're talking about stablecoins that can offer so much promise. And studies have estimated that stablecoins could reduce remittance costs by as much as 80%, right? So can you talk to us about what makes the traditional payment rail so costly and time-consuming for cross-border payments, and how would stablecoins solve those problems and reduce the remittance costs?
I think what's important to think about the way the dollar moves today is really analog. It's almost moving like the post office. It takes 2, 3, 5 days, in some cases, for money to move from one point to another, especially when there's international jurisdictions, and of course, there's high costs and fees. With the stablecoin, it will move instantaneously, 24/7, almost for no cost at all. And by some estimates right now, as much as 30% of remittances are using a stablecoin rail, in which the end user might not even realize it. Because ultimately, a blockchain is just a rail. You don't have to use it as a stablecoin as something that you know. Yet at the same time, have it move in a way that is utilizing the technology. And that's the real promise here.
Thank you. Let me ask one more question to Mr. Collison. I know that there is a concern that these funds are being sent to or from bad actors. So how do innovative payment companies work to keep bad actors from accessing funds from untrustworthy sources?
I think it's important that we recognize that stablecoins are another transport layer for money. They're the same money, but moved in a different way. And we should bring across the exact same frameworks, BSA, AML, CFT, and so forth, and apply them equally.
Thank you. My time's up. I yield back.
Thank you. The gentleman from Illinois, Mr. Foster, the ranking member of the Financial Institutions Subcommittee, is now recognized for 5 minutes.
Yeah, thank you, Mr. Chair, and to our witnesses. Mr. Cascarilla, Paxos has the ability to block, freeze, and recover fraudulent or mistaken transactions. Could you explain how this works technically, both for hosted and unhosted wallets? You know, for example, could this be used to stop the use of stablecoins for ransomware and other illicit activities?
Thank you for the question. I think this is an important point. And as the issuer of various regulated stablecoins, about 5 of them right now, we have the ability, as the issuer, because we control the smart contract, and this is an important point, we control the smart contract, we are able to decide if an address should be frozen or if funds should be seized.
All right, so for example, if someone's screen locks up with ransomware and it says transfer money into this wallet, you know, this much of one of your stable coins to this wallet, that the person who has that screen can go and contact you and say freeze that wallet and it's done.
We have a process for that, but correct, yes.
Correct, so you have the ability to put a crowbar in, for example, ransomware or other. Now that's, if you could get sort of some technical information sort of at the level of Congress's actual blockchain programmer so I'd be very interested in how that is implemented. You know, how that's obviously you have huge cybersecurity issues on your end because someone gets a hold of the ability to throw that crowbar into your whole payment ecosystem that, you know, could wreck all holders of their asset could be, you know, wiped out. It's also my understanding that the Senate, which has a bipartisan, the Genius Act that was, I guess, introduced yesterday on a bipartisan basis, has a mandate for that. And if you could comment on how that compares to what your practices are and what the pros and cons of putting that mandate. So, I'd appreciate it. I'm not asking you for something, you know, since it was issued yesterday. If you've had a look at it, I'm interested.
I think it would be nice for our staff to come back and.
Yeah, that's fine. So for the record, you know, please respond on that. Now, many of you mentioned financial inclusion and low transaction cost as really the desirable things that you're going for. Now, among the G20, India is by far the leader in that. Essentially, 100% of households are banked in India. If you, more than 1 billion people, and the only group that's not banked are women whose husbands don't want them to have a bank account, which is not exactly a financial problem. But in India, if you want to give a pauper 3 rupees, you both get out your cell phones, you do your biometric login, you authenticate your bank account, you transfer 3 rupees, 0 cost, and essentially 100% penetration. Could you explain what the advantages of a blockchain system are over the system that exists for 1 billion people in India in terms of just everything, you know? It's also my understanding that the system in place in India based on bank accounts is not usable for ransomware. It is not usable for $1.5 billion hacks. And I was just wondering if you could contrast that and particularly describe how a blockchain system would have advantages over that system. Yeah, sure.
Is that a question for me?
Yeah, sure, yeah.
I think the main
Mr.
advantage is
Collison.
that, sure.
Well, either one, yeah. Well, Mr. Collison, why don't you have a swing at that one?
I think what India has done with UPI is extremely impressive, and actually we're starting to see similar systems emerge in other countries.
Yeah, they're selling the open source software to giving it to other countries which are adopting it, at which point you'll have 0-cost payment rails across borders, which is another use case for stablecoins.
Today, these systems are not globally interoperable, and I think the most fundamental advantage that stablecoins confer is this global universality and this global ubiquity, and you don't need to wait on a country-by-country basis for them to roll it out, get adoption.
Do you regard that as a feature or a bug? You know, if you're trying to prevent fentanyl payments for fentanyl precursors, it's nice to have a measuring point at the border.
Oh,
you could. I was just wondering if you regard that an absolute cross-border zero surveillance regime is really the endpoint we should head for.
I think global access is a huge advantage, but I think to your prior questions, I think the ability for stablecoin issuers to ensure that proper controls are applied and that system integrity is maintained is also really important.
Mr. Guynn, during the 2008 financial crisis, how long did it take AAA-rated mortgage-backed security tranches to become toxic assets? And how does that compare to the monthly reporting requirement contemplated in this bill?
Sorry, it took a lot longer than the monthly reporting, but those assets are very different from the reserve assets here. Those were not U.S. Treasuries. Those were CDOs or CDO squared, very illiquid assets.
The gentleman's time's expired, and I now recognize the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thanks to all the witnesses. I know it's a long morning, afternoon. Thanks for being here. We've seen countries like Brazil allow payments not just from digital wallets or payment apps, but as was discussed a couple times this morning, also directly to and from bank accounts, as well as instantly between digital wallets from different non-bank providers. As you know, stablecoins, the lower fees, more payment provider competition, wider accessibility. And because stablecoins reduce the cost of the transactions to nearly zero, I think there's a lot of members that are trying to wrap their minds around this. And you know, they can, it just frees up retail businesses, right, with the frictionless, low-cost alternatives. So, Mr. Collison, can you just discuss, I know you've touched on this already, but can you discuss how providing kind of the regulatory clarity through the Stable Act could increase or will increase consumer adoption?
Absolutely. So I think in financial services, ambiguity is the greatest inhibitor to adoption. You know, things that are clearly permitted or clearly proscribed, you know, that's clear. And I think we've seen in stablecoins is a lot of enthusiasm, a lot of excitement, but also significant hesitation because you know, well, it's not clear how the ecosystem is going to unfold within the U.S. I think the single most the single best way to ensure that US dollar stablecoins are broadly adopted around the world is for Congress to provide that regulatory clarity.
Right. In a regulatory framework, will also give businesses more incentive to use the stablecoins for operational transactions, right? Wouldn't you agree? Some stablecoin, I know that some of the issuers are establishing kind of strategic partnerships, I guess you'd call them, and trying to link up with traditional payment companies. So, Mr. Cascarilla, can you discuss some of Paxos partnerships and explain how these kinds of relationships that you guys have been able to develop helps with the integrations and the incentivizing the adoption of all this technology, right?
Well, I think one of the interesting components about a stablecoin is that the interest is being kept by the issuer, as a general matter. In our case, we are setting up partnerships where the interest is being returned to the distributor, whoever might be controlling the end user as a payment company or otherwise.
Right.
And that's an opportunity then to eventually maybe pass that on further through rewards to the end user. So you create an ability not just to democratize access to dollars, which is I think what stablecoins do, but you could even start democratizing access to the risk-free rate. And that's a really important way of changing how the financial system works and how individuals are able to access it.
So let me go back, Mr. Collison. So there's been some confusion as to the difference between U.S. CBDC, a stablecoin, and the FedNow system, right? I mean, it's I hate to pick on the Financial Services Committee, but I think it'd be hard pressed to get somebody to come up with a definition for all three. Would you describe the differences between the three and the issues that they're seeking to resolve in the U.S. payment system? How do you view those three topics or headings, I guess?
I think FedNow provides a valuable service for making interbank transfers within the U.S. more streamlined, and that's very helpful. It doesn't provide the same degree of global access that stablecoins or, in principle, CBDCs could. With respect to stablecoins versus CBDCs, I think that the US gets basically all of the benefits of a notional CBDC without some of the attendant downsides that have been discussed here today. And so my view is that there's very little downside and tremendous degree of benefit to formalizing stablecoins along the lines of what's proposed. And beyond that, I don't really see how a CBDC would help. And to again some of the points made, I think it could easily inadvertently inhibit innovation.
Thank you very much. Thank you all, and I yield back, Chairman.
Thank the gentleman. The gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Guynn, if I can start with you. You've emphasized the importance of legislation in the stablecoin industry. I've been a supporter of the stablecoin legislation for a long time, introducing one of the original piece of legislation and being supportive of the Payment Stablecoins Act in this committee last year. Could you explain to us what your experience has been with the current status quo? What would happen if there was a further delay in congressional action?
I think the problem is that we risk, until we bring stablecoins into the regulatory perimeter, we risk having stablecoins that are not structured appropriately the way this bill would do it, and for instance, your bill would have done it. And I think that the real benefit is having a regulatory structure that sets minimum that anyone who is identified as a licensed stablecoin issuer would be adhering to.
Are there any specific oversight measures you think should be included in that comprehensive framework?
Well, I think the framework now allocates the oversight to either state regulators or one of the federal regulators with a federal framework that really is the anchor for it. There can be alternative state regulatory frameworks, but they have to satisfy the same standards. So I do think that there is a good anchor there, and seems like there's as much oversight in this framework as there is in the dual banking system.
And would you support requirements for regular audits and transparent reserve reporting, which I believe help prevent banking failures like we saw in 23?
Yeah, I think those are absolutely critical, not only for preventing that, but also just publicizing in some ways to the public who wants to use this as to which are the safe stablecoins and which weren't. They can look at the disclosure and make informed decisions.
Thank you. Mr. Cascarilla, as someone heavily involved in the international payment system, you're familiar with threats to the dollar's role as the global reserve currency. China is heavily promoting digital payment systems from Alipay and Tencent in countries that are involved in the Belt and Road Initiative. They're also, as you know, seeking to make Hong Kong into a major player in global crypto markets. How might a clear U.S. regulatory framework for stablecoins affect international adoption and strengthen the dollar's global position? Well, I think it'll be a very significant boost because it'll create a level of trust in the usage of stablecoins that right now still does not exist. And if you look around the traditional financial system and the desire to be able to use stablecoins, it's very significant. And until you have this regulatory clarity, traditional financial institutions, as well as more widespread consumer adoption, is just going to be limited. And that, of course, creates opportunity because other nations and other currencies can take advantage of that. Thank you so much. And Ms. Butler, you discussed BNY stablecoin activities out of its New York State chartered bank. State chartered banks play a critical role in New Jersey, where I'm from, and the economic opportunities that stablecoins offer are continuing to grow. Do you believe the proposed dual federal-state structure in the stable bill is sufficient for both bank and non-bank stablecoin issuers?
So we support federal consistency, no matter what pathway you choose, whether it's state or federal, but we need to have federal standards applied consistently to all.
Thank you. If I can move quickly to Mr. Collison, one of my primary concerns is that without proper guardrails, more crypto companies will flee overseas to jurisdictions like Bermuda, the Bahamas, or France, who already have comprehensive regulatory systems in place. And I worry that giving them first mover advantage will allow them to we're allowing potentially adversarial jurisdictions to set the playing field on a global scale. What specific competitive advantages are other countries gaining in the digital asset space, and what does the U.S. need to do to maintain its financial leadership?
Well, most importantly, I concur. I think that's a risk. And I think by far the most important thing that the U.S. can do and that Congress can do is to provide a clear and effective framework for stablecoins here in the country. And I think in broad strokes, that which is under discussion today does that.
Thank you so much, and I yield back. Thank you.
I thank the gentleman from Nebraska, and also the chairman of the Housing and Insurance Subcommittee, Mr. Flood, is now recognized for 5 minutes.
Thank you, Chairman. My interest in stablecoins goes back to the work I did in the Nebraska unicameral legislature on this very issue. After my bill entitled the Nebraska Financial Innovation Act passed, Nebraska became the second state to have a regulatory structure for a new kind of state-chartered bank called a digital asset depository institution. A Nebraska digital asset depository institution can issue stablecoins, which puts my state in a unique position as it relates to the broader debate about a state pathway within this bill. Due to the laws in our state, I'm interested in the state pathway specifically as it relates to state-chartered bank issuers. My hope is that any federal stablecoin legislation will work hand in glove with our Nebraska Department of Banking and Finance and the work they are already taking on these very issues, and I appreciate the continued dialogue we've had with Chairman Hill and his team on ensuring that we strike just the right balance. Mr. Guynn, can you please walk through your understanding of how the Stable Act would regulate a state-chartered bank subsidiary that issues a stablecoin pursuant to the bill's state pathway?
So as I understand it, there's sort of two possible regulatory frameworks. One is 4A, which sets federal standards, and then 4B that would allow a state to have an alternative regulatory regime that would satisfy or exceed those standards. So it's a little bit more restrictive than the dual banking system, where states have a little bit more freedom because the federal standards simply, it's not that they don't apply, it's that they cover a much narrower field of applicability, whereas here the standards are pretty comprehensive.
Good answer, because you answered my second question about how it compares to the dual banking system, so thank you. I'd like to emphasize a few things about the state pathway before moving on to my next question. One is that state regulators must get a certification approved by the Treasury, as you've said, showing that their state regime is in line with the bill's federal requirements or exceeding the federal requirements. In addition, there is an exigent circumstances provision in the bill that would allow a federal regulator to step in over a state regulator and enforce directly on state issuers in certain circumstances. And quite honestly, this has concerned me, just what is an exigent circumstance, but in other words, even the state pathway has a very extensive federal involvement. With that caveat, I'd like to highlight a line in Mr. Cascarilla's testimony, which said the following as it related to cross-border regulation of state-chartered stablecoin issuers, and I quote, "Primary oversight should remain with state-chartered issuers, home state regulator, avoiding redundant regulatory burdens," end quote. Mr. Cascarilla, if a state pathway for insurance doesn't include some form of regulatory primacy for the rules of their home state regulator, would state issuers juggling several state regulatory laws be at a disadvantage relative to issuers that receive a federal charter?
Yes, they would, and I think that is the exact point, which is today, as a state issuer, you have to juggle a number of different state approvals and exams, and that is a conflicting process that takes up a lot of resources and could certainly snowball in a situation like this.
And I appreciate that answer. And let me just say this, does anybody in this room not think that the New York DFS could handle this? I mean, we have to respect the rights of states to have their own regulatory regime. Mr. Guynn, can you comment on the same question? You know, juggling all these different regulators, does it put the state chartered issuers at a disadvantage?
So look, we get this question all the time from state issuers as a law firm. There's always a choice, but having a choice between a state and a federal regulatory authority is a good choice to have. And so it may well be that a particular institution decides, I have more freedom to innovate if I'm regulated by a state, even if I have to go through the headache of looking at all these different state laws. Whereas if I go with a national regulatory, then it will be preempted.
Totally agree. And let's remember, what makes America the best financial market in the world, what makes us so successful is that we have diversity in our banking. We have the GSIBs, we have the regional banks, we have the community banks, we have the federal chartered, we have the state chartered, and we have innovation. When you control all of that, you get Europe with a couple of banks and a couple of board of directors that are making the decisions for every consumer on the continent. And so let's celebrate what makes America strong by encouraging diversity, relying on states to manage and regulate state issuers of stablecoins with appropriate safeguards. I want to compliment Chairman Hill, Brian Stile, Mr. Davidson, Allison, and all of the work that the staff has done. We are in a good place because of the hard work of this committee, and I'm excited to see this bill pass. With that, I yield back.
Thank the gentleman. The gentleman from Texas, Mr. Green, who's also the ranking member on the Oversight and Investigations Subcommittee, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, and I'm grateful to the witnesses for appearing today. I would like an expression of whether or not it is beneficial for us to be concerned with the use of cryptocurrency in certain areas. More specifically, is it beneficial to use cryptocurrency of some type in money laundering, terrorist activities, ransomware attacks, illegal trafficking of drugs, sex, weapons, illegal gambling, and evasion of taxes? Ms. House, let's start with you. Is it beneficial for us to be concerned about the use of some sort of cryptocurrency with this type of criminality?
It's beneficial for us to be concerned about it, if that's what you mean, if
Yes.
it's beneficial for us for its use in that way. No, it's not. It's only beneficial to those who are currently exploiting it. It's not inevitable to stay that way, but the current state of compliance across the ecosystem makes it attractive for those users.
Explain what you mean by the state of compliance.
Yes, sir. So basically, I was the head delegate to the FATF, the UN for anti-money laundering. If you're not familiar with it, we created the first international standards for virtual assets in anti-money laundering. The standards exist, the policy exists. It just hasn't been implemented internationally. If we had wide-scale cross-global implementation of our requirements to detect and prevent illicit activity and to stop use of, like, let's say, sanctioned actors in North Korea's use of cryptocurrency and that's successful ability to launder, we wouldn't be in this current position. Unfortunately, it hasn't been implemented internationally.
Does the bill in question prevent this type of illicit activity?
I don't feel that the anti-money laundering measures in it are strong enough. It makes a reference to them being regulated under the Bank Secrecy Act, but there isn't clarity on who's purporting the regulations or how strong they need to be.
And as a result, would we still have exposure to the criminality that I called to your attention?
I fear that if we don't strengthen the measures, that could be an outcome, especially the extraterritoriality provision.
Is there a rush to judgment here, meaning a rush to, I shouldn't say judgment, a rush to get this done such that we don't have the time to carefully craft legislation that will help us prevent this type of criminality?
I would hope that even with the exigency of the issue, that given the years of bipartisan work that have been done by many members of this committee and those sitting in this room, we'd be able to leverage that work. I feel that the outcome of that work was more reflected in the the McHenry Waters bill, which had a more holistic coverage of these protections. I'm not certain why the new legislation doesn't integrate some of those stronger provisions, which I think would be beneficial.
Would implementing those stronger provisions somehow weaken that legislation, this new legislation?
I don't feel so. I think it would strengthen it and make it truly comprehensive.
And do you think that the McHenry Waters legislation had other redeeming value?
Absolutely. I think that it had a much more fulsome, like, holistic list of different measures. There was some good overlap too, things like one-to-one capital reserve requirements and a restriction on rehypothecation and investment of depositors' assets, basically. But unfortunately, I feel that the Stable Act is missing some of the most important provisions also that are outlined in the McHenry Waters bill.
When this illicit activity takes place and there's a transfer of money in an illegal fashion, for illegal purposes, more appropriately, who benefits from that in the system?
Currently, the illicit actors benefit from it. I think that no responsible actor wants to be a platform for money laundering or for North Korean sanctions evasion and proliferation financing. So really, it's the illicit actors that are benefiting from lax controls.
Quickly to my last question. So when this occurs, does the the people who are purveyors of the currency, the persons with the system, do they get punished in any way?
there should be enforcement actions that can be taken if they fail to meet compliance obligations.
Thank you, Mr. Chairman. I yield back.
Thank the gentleman. The gentleman from Montana, Mr. Downing, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses. I came out of technology, and my formative years, I was part of a company that built really one of the world's first massively scalable computer systems. It was an exciting, innovative time. And I've always said that the United States of America must be the hotbed of innovation, and we cannot cede leadership over emerging technologies to other countries. And that starts with Congress passing clear laws governing cryptocurrencies. And I applaud Chairman Stile for his leadership on the Stable Act, which continues to receive industry feedback. I'm going to start, Mr. Collison. One notable change in the discussion draft of the Stable Act from the 118th Congress is making the OCC the primary regulator and supervisor of non-bank payment stablecoin issuers. So can you discuss the benefits of allowing the OCC to serve as the primary regulator and supervisor for non-bank stablecoin issuers?
We don't really have a strong view on what the best primary regulator is. I think the two things that are of greatest importance are, one, that there's an effective state-based framework for experimentation, and that secondly, there is simply a clear framework at the federal level. Within those kind of two principles and within reason, I think there's probably multiple avenues that could work.
Thank you. I want to move on to central bank digital currencies, or CBDCs, which represent one of the greatest threats to civil liberties in our lifetime. The American people expect our payment system to operate efficiently without offering the federal government a window into their day-to-day transactions. And look no further than the authoritarian countries pursuing CBDCs, which are not being used for innovation, but for surveillance, for stopping dissent, like China and Russia. I don't trust the federal government with any of my data, let alone financial data. I once got a letter from the federal government telling me, we're sorry, but all your data from your security clearance has been released to a foreign actor. Here, we'll give you a couple of years of credit monitoring. You're welcome. I've got issues there. So I'm going to go to Mr. Cascarilla. Some CBDC advocates say that issuing CBDC is the only way to improve the efficiency of our payment system, because stablecoins are some sort of Wild West, where crime and money laundering will run rampant. So, first, is that true? And then second, are law enforcement officials incapable of combating bad actors in the stablecoin ecosystem?
Well, I think that from studies that have been shown and done, they have shown that the amount of illicit activity that's happening in crypto, stablecoins, and blockchain is less than in the traditional financial system, precisely because there's an ability to be able to track movements on-chain forever. And that is an important way to create a new set of tools, as well as being able to create a new set of products to be able to track what's happening. And then secondly, there really isn't an analog to the government offering something to the end user aside from physical cash. It doesn't do it through, it doesn't run its own banking system. It doesn't offer mutual funds, money market funds, et cetera. And in the same way, I don't think that we're going to promote innovation by having the central bank issued digital currency compete with private issuers.
Well, thank you. So would the Federal Reserve's issuing CBDC discourage or crowd out digital asset innovation in the United States?
I think that it will actually crowd out innovation and slow the adoption on a global basis of using the dollar, precisely because I think some of your fears would also be shared by others outside the United States.
Let me go back to stablecoin regulations. The prior administration was no fan of digital assets and payment stablecoins. The SEC under Gary Gensler tried to treat all cryptocurrencies the same as a security, despite many cryptocurrencies clearly serving different purposes. Section 14 of the Stable Act clarifies that payment stablecoins are not securities. So I'm going to go to Mr. Guynn. Can you explain why regulating payment stablecoins as securities is impractical?
So the whole goal with payment stablecoins is for it to be accepted as a no questions asked payment instrument, just like a bank deposit. If it is treated as a security, it'll be subject to all kinds of disclosure requirements, which is completely inconsistent with that. The disclosure here are the disclosure requirements in the Stable Act and the structure saying the stablecoin has to be 100% backed by safe assets and things like that. So actually having it be a security would actually undermine the ability of achieving a no questions asked money status.
Well, thank you. Unfortunately, my time's expired, so I yield.
I thank the gentleman. The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Thank you, Mr. Chairman. As a New Yorker, I'm interested in gaining some insight into New York Department of Financial Services, who's been on the leading edge in the reality of how their processes are working in practice. Mr. Cascarilla, since Paxos received the first limited purpose trust charter for digital assets from the New York Department of Financial Services in 2015, can you tell us a bit about how Paxos's experience working with them has been?
Well, we were the first trust that was approved really in the country, and it was by New York. And the idea had been at the time that as an infrastructure provider, this would be a very strong way to be able to hold client assets, not just for dollars. We also have a gold stablecoin and others. And we have been able to successfully create some of the most innovative products in the financial system and in the crypto space because of the oversight of the New York Department of Financial Services.
What specifically would you attribute as working well, and what do you think could be improved?
Well, I think, when you launch a new product, there are many different concerns you have to take into account around customer protections, around safety and soundness, around the ability to operate. And New York has put in place a framework for issuing stable coins that has now been the basis for really the frameworks that have been adopted in a number of other jurisdictions. We also issue stable coins out of both the UAE and Singapore, and they are very substantially similar to what New York pioneered.
So I know in your opening statement you touched on your support for reciprocity with other jurisdictions globally that have strong frameworks. Do you think the New York Department of Financial Services should be looking at approving stablecoins that are already approved by other jurisdictions with high standards?
Yes, I think that creating a common level of reciprocity for tokens that are issued at the same type of safety and soundness level is just critical. You don't want to balkanize the market. If you balkanize the market, I think you then create opportunities for other currencies and other types of countries to take advantage of it.
Now, one of the stories that we've consistently heard from opponents of digital assets is how it provides a significant source of financing for terrorist groups and other illicit activities. And while we must ensure we're combating malign actors, according to recent reports, illicit activity is down, with analysts estimating that crypto transaction volume associated with illicit activity is only 0.34%. Mr. Cascarilla, you already detailed a bit of the work you're doing on due diligence with Mr. Casson, but can you describe, and Mr. Collison, can you describe some of the issues that are considered when institutions are working through these KYC/AML requirements, and how do companies like Coinbase approach these requirements?
In our case, we are approving customers through bank-like standards. We're regulated in New York under banking law. It's AML, KYC, and BSA rules similar to any other financial institution. And that's important. We want to make sure we know our customers. We want to make sure that we're doing our best to stop illegal or illicit activity from happening through our products. And so far, I think we've been able to show that to a number of large enterprises that use us as their infrastructure. And the importance of making sure that you have those right types of controls in place is what then gives the world the confidence to use these products on a broader basis.
Mr. Collison.
We have a very strong incentive to not only clear the bar of complying with the law, but to do everything possible to reduce and to eliminate fraud in our ecosystem, because it's actually one of the main reasons that customers come to us. Customers come to us if they're implementing some platform or some little product suite. They often find the fraud that they experience online themselves to be unmanageable, and they come to us for assistance. So we try to lead the industry in this respect, and just like Mr. Cascarilla said, we apply the exact same BSA, AML, KYC, CFT, et cetera standards for our sector.
Great. Thank you. I yield back.
I thank the gentleman. The other gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Chairman. Thank you all to the witnesses for being here today. Ms. Butler, New York was the first state regulator to come out with guidance related to stablecoin issuers. I know you chatted with Mr. Muser on this topic before. However, as a New York regulated bank, could you please discuss how you comply with sound custody and disclosure practices?
Thank you very much for the question. So we comply with sound custody practices by ensuring that there's asset segregation. We apply AML, BSA, and KYC practices. We have robust risk and control infrastructure around record keeping, as an example.
Sounds like you do quite a bit.
Yes.
And in January 2023, New York DFS released additional guidance reiterating expectations for sound custody and disclosure practices for payment stablecoin issuers. Mr. Cascarilla, you were just talking with my colleague about some of these. Can you discuss the released guidance in particular and highlight changes, what changes were required for issuers?
Well, the guidance actually didn't change anything from our perspective. We were already following that guidance. But I think what it set was a framework that other jurisdictions and other issuers could then follow. So
it raised the bar for other people.
Yes, I think there were a number of other stablecoin issuers who weren't following the idea of backing their stablecoins with cash and cash equivalents, a true one-for-one basis, or with something that would be readily redeemable. And so while it didn't change what we were doing, it certainly led to other issuers changing how they operated.
That's good. The recent draft of the Stable Act updates permissible reserves outlined in the previous draft released by Chairman Hill and Style. These now include Treasury bills with an issued and remaining maturity of 3 months or less, reverse repo transactions backed by these Treasury bills as collateral, and money market funds invested in improved assets. Mr. Guynn, can you explain how these reserves function as cash equivalents and ensure stablecoins are truly backed one-to-one?
So first of all, if you actually, in some ways I think that's too restrictive, but if you actually had a reserve where the maximum maturity is 3 months, typically an issuer would actually ladder those securities. So the average maturity is probably more like something called duration, is probably more like a month or a month and a half. That means that even if there's a pretty big swing in interest rates, the value of those assets only goes down by a modest amount. And so it makes it very easy then to liquidate those if you needed to liquidate them to redeem stablecoins. And to the extent there's any drop in the value below par, the Stable Act would require at least a modest capital buffer that would be used to make up the difference.
Our dual banking system, regulatory system, where state and financial regulators share supervisory and regulatory authority, has worked well as it utilizes the strengths of both federal and state regulators while allowing states like New York to remain laboratories for innovation. So Guynn, would you comment on how a national federal framework can complement the work that has already been done at the state level?
So assuming that the 4A, I think, is consistent with the state regulatory framework in New York, so I don't think it changes things, but it would create a floor for all other states. States would not be able to create regulatory frameworks that were more relaxed than the federal standard in Section 4A of the Stable Act. What states would be allowed to do is to have more rigorous standards or just apply things differently in a way that allows for more innovation.
Is that something you agree with, setting the floor but not a ceiling?
Yes, it's a floor, not a ceiling.
And you agree with that?
I think in the dual banking system, there's a little more leeway for the states to actually have their own regulations. I could see allowing more leeway for the states here, but that's not what the bill is doing now.
Okay, I appreciate that. And with that, I'm going to end early because I know the conference chair would like to ask questions before votes are called. So, Mr. Chairman, I yield back.
Yep, I thank the gentlewoman from Michigan, also the chair of the Republican Conference, Ms. McClain, is recognized for 5 minutes.
Thank you, Mr. Chair, and thank you all for being here today. I appreciate it. I want to start with Mr. Cascarilla. I want to understand and explore more. Many stablecoin issuers, including Paxos, have set up operations in foreign jurisdictions. Why did you decide to make that decision to set up additional operations abroad? What was the thought process behind that?
There's a number of different reasons. I think the first important one is those jurisdictions had a clear set of rules. You had the clarity, the consistency, and the certainty to be able to invest for a long period of time. We have operated out of Singapore for over 10 years, so we've been there for quite a long period of time, and the Monetary Authority of Singapore is a very credible regulator. At the same time, there wasn't a federal framework to be able to operate inside the U.S., and as well-intentioned as the New York Department of Financial Services has been, it's still a state regulator, and in order to be able to operate on a global basis, you need to be able to have, I think, a federal framework.
Thank you. And in your view, what would happen if we fail to enact a federal framework?
Well, I think you're ceding leadership and potentially ceding the position of the dollar as a world reserve currency.
Interesting, thank you. Mr. Collison, how are small businesses and entrepreneurs using stablecoin to facilitate more international operations?
We sometimes discuss an idea at Stripe, the micro multinational, in that if you employ 10,000 or 100,000 people, it's possible to serve 100 markets or something like that. But as a much smaller business or a business just getting started, that's much more difficult. And so I think part of the promise of stablecoins is that for those businesses that are just getting off the ground, it enables them to serve a global audience from day one, and that can multiply their market and thus their revenue quite significantly.
Which is a good thing, yeah. Ms. Butler, BNY is one of the world's largest custodians. It is essential that the Reserve Bank backing stablecoins are secure and transparent. Can you describe how BNY Mellon keeps the stablecoin reserves that it manages safe and that is fully able to meet all of the redemption requests at any time?
Thank you very much, Congresswoman, for your question. So we are the custodian of the reserve, and as such, we apply long-standing custody practices around asset safety, so similar to what we do for the 52 trillion of assets we have under custody. We are not the reserve manager of the reserve itself. That is held by either the stablecoin issuer or a separate reserve manager.
Okay. Is there a concern on meeting redemption requests, or do you feel there's enough regulation around that and how the system is set up?
So we support the proposals in the bill to make sure that there is the right safeguards on how you manage the reserves, what assets are in the reserves, how you disclose them, and ensuring that there is regular audits on those reserves.
Transparency is good then. Yes, it's good. Mr. Guynn, it is my understanding that Stable Act establishes a federal floor, right, of requirements that all payment stablecoin issuers must meet in order to issue in the United States. So I think that floor is extremely important. Can you explain in layman's terms why it is important to ensure that regulatory framework for payment stablecoin establishes a baseline across state and federal jurisdictions?
Sure. So basically, having a federal floor creates uniformity across the United States and across different stablecoin issuers. And I think that's important so that it'll be easy to compare and say everybody is subject to the same standards. There could be some disuniformity, but only by increasing the standards from state to state.
So it provides a level playing field. It's easier to operate, to do business, to figure out how to function if I'm a...
Much easier to understand too and apply, yes.
Okay, thank you. And last question, if I can, Mr. Cascarilla, there is a tremendous concern about the use of digital assets in money laundering. How can stablecoins be used to reduce illicit financial transactions And what protections are included in the Stablecoin Act to inhibit nefarious financial actors? In essence, keep out the bad actors.
Yeah, I'll try to be fast. There are requirements for AML, KYC, and BSA. And then secondly, because it's on a blockchain, it's a forever ledger. You're always able to track movements. And so you can now use different tools to be able to understand how illicit activity is happening.
Very good. With that, I'm over time. Thank you, Mr. Chairman. I yield back.
Thank you. The gentleman from Iowa, Mr. Nunn, is now recognized for 5 minutes.
Well, thank you, Chairman Davidson, and I appreciate you all being at this very important hearing. We are on the cutting edge here. Stablecoins offer a powerful opportunity to build a modern and efficient payment system and shape our financial future. The United States won't and shouldn't sit back while countries like China and Russia try and occupy this space. So I'm encouraged by this committee's thoughtful discussion and its action. Mr. Collison, as a leader, both as co-founder and now CEO at Stripe, you're on the forefront when it comes to financial innovation. In fact, you know what technology looks like because you've been doing it. Over the next decade, I believe we'll see a dramatic shift towards real-time, data-driven payments and deeper integration of the financial services, and candidly, in everyday life. By passing a stable act, we can unlock a wave of American leadership in digital payments, all while upholding our nation's high standards of consumer protections. Could you talk to us here about how you see the payments landscape evolving over the next 5 years, and what role stablecoins might play in shaping that future?
Well, I think you summarized it very nicely yourself just there. I would maybe briefly add, first, I think there are immense opportunities within the US to make things cheaper, more efficient, faster, easier to use. The US today is one of the most expensive countries in the G20, I think the most expensive, in fact, for just basic money movement functionality. There's also a World Bank report this year showing that not only are remittance costs quite high, but they're actually increasing rather than decreasing over time. So there's a lot of opportunity here. And then I think the second angle that's very compelling is the global access to dollars, which is going to enhance the status of the dollar as the world's preeminent reserve currency. And that has geopolitical benefits. It also has straightforward fiscal benefits in lowering U.S. borrowing costs. And so I think the benefits are very extensive.
And I think an important point to drive home here is this is American dollar-backed stablecoins, which really help drive this space. God forbid we ever get into a renminbi-backed stablecoin or ruble-backed stablecoin or whatever else is going to be out there. Being able to help drive this as part of our economic engine here in the United States, along with the security that comes with that, puts us in the driver's seat for decades to come. Thank you. Ms. Butler, you're head of digital assets at BNY. You operate globally. You've seen a lot of this stuff take place. However, your experience is working in other jurisdictions, particularly Europe, London, Singapore, others, compared to what we've got here in the U.S.
Thank you very much for the question. There's increasing clarity in other jurisdictions that enable us to actually meet the needs of our clients in a more real way. With clarity coming out of the proposal here, we'll be able to do the same and apply our services to US dollar stablecoins, not just in the traditional space that we do today, but also increasingly across the whole spectrum of payment services related to stablecoins.
And I would agree with you. Our inability to get some kind of framework here has driven great innovators, investors, and opportunities to the Caribbean, to London, to Singapore, and in worst case scenarios is actually pushing them into the arms of Pyongyang, Beijing, and Russia. Look, Ms. House, you and I got to serve together on a number of national security aspects. Would you agree with me that lack of clarity in this area or lack of regulation could potentially jeopardize the future of America's ability to be competitive in this space?
Yes, I think it already has.
With that, the lack of opportunity, I know Stable Act may not be exactly what you are looking at, but could you talk to us about some of the things that you think the Stable Act is driving and building out that framework?
Absolutely. There's some points of commonality with other legislation that I like, and I know I've referenced the McHenry Waters legislation. So things like the one-to-one, high-quality liquid like reserve requirements is really great. The restriction on rehypothecation of assets is good. The reference to cybersecurity controls in the wake of $1.5 billion hacks that have happened lately. So I think that there's some good measures that are in there. There's just some other areas that I think bipartisan legislation that's been worked on in this committee can actually help fill the gaps on.
Ms. House, and thank you for your work at the Atlantic Council. I do believe this is a bipartisan issue. More importantly, it's an American issue. If America doesn't start leading in this area, we have the opportunity to bleed out. Mr. Carole, you have highlighted here in our time left, I want to give you a little more time to talk about, I look at illicit financing as being a real challenge in this space. How can Stable Act actually help us clamp down on illicit financiers?
Well, I think, first of all, it sets a set of rules for AML, KYC, and BSA, which does not exist today for all issuers, and does not, and it also, I think, sets this floor for what people will be able to do and how they will issue on a global basis, so for international issuance as well.
Very good. Thank you very much for the time today, Mr. Chairman. I yield back.
Yeah, thank the gentleman. The gentleman from North Carolina, Mr. Moore, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ensuring America continues to lead in financial innovation is not just about industry growth. It's also about giving consumers better choices, improving financial access, and protecting consumer privacy. Blockchain technology and digital assets are already transforming the way Americans and businesses transfer value. That's why this week I plan to introduce the Financial Services Innovation Act. This bill aims to ensure the United States remains the home of financial innovation by establishing the Financial Services Innovation Offices within each financial regulator and a federal sandbox for innovative financial products and services. The regulatory sandbox approach has proven successful in states like North Carolina, which launched its financial and insurance regulatory sandbox through the North Carolina Innovation Council in 2021. I just have one question. Ms. Butler, in North Carolina, our regulatory sandbox has fostered innovative services that reduce costs for consumers, they expand access to credit. My question simply is, how will, at the federal level, a regulatory sandbox approach accelerate adoption while ensuring proper oversight?
Thank you very much for the question. I think first and foremost, we're seeing a number of sandboxes where we can actually experiment in a controlled way, and that's giving us the ability to really test out the technology. In addition to that, though, we really do need the rules. We need to have the clarity of the rules. We need to have those rules applied consistently across all players in the ecosystem, and I can't underscore that enough. It is super important that everybody, particularly that is issuing and managing and custodying any part related to a US stablecoin, those same rules and high standards are applied, and then you get to experiment within the safety of a sandbox.
Thank you, and I want to thank all the witnesses for their testimony before the committee today. With that, Mr. Chairman, I yield back.
Thank the gentleman. I would like to ask, thanks all the witnesses. I appreciate your testimony today. And without objection, all members will have 5 legislative days to submit additional written questions for the witnesses to the chairman. The questions will be forwarded to the witnesses for response, and witnesses, when you receive them, please respond no later than April 15th. This hearing stands adjourned.